Well, hello, everybody, and welcome to another episode of Financial Learning. This is a live video. I'm going to be breaking down the Mullen's latest 10K video. Thank you all for whoever joined live. I'm sure we'll have some others join us as we go along. I will be paying attention to the chat, so make sure that you're interacting with me and I'll interact with you. So without further ado, let's jump right into this thing. All right, so starting from the very top of the 10K, and if you would like to follow along yourself, I did add a link to the 10K in this video's description. So please make sure that you are paying attention. Hey, Matt K, how you doing today? Thanks for joining in live for me going over the 10K right now. Starting with page one here for the 10K, there is a couple of really good things I want to make sure I point out here. Starting over here, we can see the total number of outstanding share counts as of January 21st, 2025. And that is 61,595,743 shares. I will go ahead and probably add in the comments what the last share count disclosure was. It's probably in one of those DEF 14 filings when it comes to the shareholder vote. So I'll take a look at that and see exactly how many additional shares were added. I was going to bring a Mountain Dew and relabel it Mountain Dilution, but we will go ahead and continue on and we'll see what type of share count changes we had between this filing and the last quarterly filing. All right, and then one other thing on this page before we do move on, just want to point out, I believe that this uh, section here, this is as of March 31st, 2024. I believe this is a typographical error. I don't know why they would be talking to us in terms of the aggregate market value of the registrant's common equity, other than held by persons who may be deemed affiliates of the registrant as of March 31st, 2024. So again, I think that's kind of odd, and it says here 40.7 million. I found a couple other typos. I believe they are. If I'm wrong, please drop a comment in the chat and let me know. I will be clicking over near the end of this, and we'll take a look at some of the posters there on X. But let's just go ahead and continue down in here. Skip the table of contents. I am going to take a little bit of time to go over the forward-looking statements. They do break each one of these bullets down with some additional details. So I will go ahead and jump past this section. I'll come back if need be, but let's go ahead and just continue on for the moment. And before we start on the first forward-looking statement, I think it's important as an investor that you realize the importance of those forward-looking statements. The purpose of those is to protect the company that is putting out the filing from any type of legal repercussions for not making the investor aware of specific situations that could occur. So this is basically like I wouldn't say get out of jail free card. How about a get out of fine free card, right? So I think it's important that you realize exactly what these forward looking statements are. It's basically letting the company cover all its bases. As long as it's disclosed somewhere in one of these forward looking statements, the company is allowed to have it happen. And there's going to be no repercussions, in my opinion. So let's continue on. They do talk about their website, media disclosure. I'm sure you're all aware about that. It's not really relevant for this 10K, so we'll go ahead and skip it. And then the business. If you are tuning in, I'm sure you're aware of Mullen Automotive. They do have a couple of EV vehicles, an electric van, an electric truck. They also have the Bollinger commercial trucks as well. We're going to talk a little bit more about those as we continue on when we take a look at some of the revenue items as well as some of the expense items. So I'm going to kind of skip this section here about the company. Again, if you want to take a look at this, by all means, it's on the SEC filing. You can definitely take a look. You can also look at the company website to get a little bit better idea if you are new investing into Mullen Automotive. By the end of this 10K review, I hope that you will have a better understanding of exactly what's going on in terms of their financial situation. So skipping company overview on their strengths and strategies, the market opportunities. This is that Mullen Class 1 van, Mullen Class 3 truck. This is the Bollinger Motor commercial vehicle that they do have. They've had a couple of sales of this vehicle. We'll talk about that later on. There's the Mullen iGo. Haven't really seen any vehicle sales yet for this thing. And then their battery technology. I wanted to go ahead. I did take a snippet of this section here. They talk about the company using lithium ion battery technology for their first couple of vehicles. But then one thing I wanted to point out, it's actually down below the photos here for the solid state development. It says Mullen is currently in development of a semi-solid state battery to be used initially in their Class 3 vehicle. Early vehicle testing was completed in March 2024 on the Class 1 vehicle. The company has plans to introduce this technology into the Class 3 vehicle lines after full vehicle testing and certification has been completed. I find that rather odd, a little bit alarming that there was a PR put out almost a year ago in terms of the Class 1 van and the solid state battery testing. If you do recall, they did have a video, if you want to call it that, of a person running a test on the van, and it appeared that everything looked okay. We haven't really seen any additional testing on that Class 1 van, but I find it very odd, again, that they are pivoting from the Class 1 vehicle after doing the testing to move to the Class 3 vehicle. It's almost as if they are trying to extend the time. And if you are familiar with this Fullerton facility, there has been additional PR as well where they were talking about moving some of the battery manufacturing line all the way to Mishawaka. I thought that the intention of purchasing this Fullerton facility was to be able, again, this was from a previous PR, was to be able to provide a line to run the lithium ion batteries and then also have a separate R&D line for that solid state battery development. So I find it very odd that they're already pivoting their facility again to move to Mishawaka, which is set up for installing and assembling their Class 1 van. So I'm not really quite sure why the resources would be getting shifted over to that vehicle or, sorry, to that location. If you have any ideas why and it makes any sense, I'd love to hear from you about that. Moving down, vehicle manufacturing, yes, talking about the Tunica, Mississippi facility. There's some old photos from their 100th vehicle, which again was for a little over a year ago. So very, very interesting. A lot of these photos have been reused since then. Mishawaka Manufacturing. This is the one I was talking about originally for that General Motors Hummer H2. And then the last time these vehicles had, or this location was using some of those Elms vehicles. So again, interesting. It's been shut down this whole time. Class 1's moved to Tunica. This remained idle, and now batteries are going to go in. Doesn't really seem like a very good use of the resources. All right, and moving down, Bollinger Manufacturing, we're going to skip this section here, and then the commercial sales distribution. I don't really want to go over a recap of the company's activities. You can definitely take a look at some of the press releases. It is going to be interesting when you read those press releases, you will see specific statements about how much revenue the company is expecting for specific quarters, and then how much was invoiced and vehicles sold. I find it interesting that we're going to see it throughout this 10K filing that those numbers do not quite line up. But with that being said, looking at their dealers, they did have Randy Marion as old as 2022, December of 2022, and then they expanded during this last year in 2024, added Pritchard, Pape, Eco Auto, Ziegler Truck, and then also National Auto Fleet Group. So think about it, they've got now 6 dealers, at least listed right here. And we'll take a look at the overall number of vehicles sold in just a little bit. Again, they talk about this after sales strategy, government procurement opportunities, vehicle fleet connectivity, and then also some additional distribution networks for Bollinger sales. So jumping down into vehicle marketing, they do talk a little bit about that, about their demos. We've all heard a lot about these specific demos that they were providing various companies, various owners to see how these vehicles actually panned out. To my knowledge, I have yet to see a large company purchase a large batch of vehicles. So far, it's been one vehicle sales to a local contractor type individual. And then we all know about the Volt Mobility snafu, and we will go through that. There is a disclosure about that as we continue on. looking at Bollinger Motors vehicle marketing, just a full list of how they market that specific product, and then getting down into the R&D section. They talk about their intellectual property, they talk about their patents, they talk about a total of 287. One section I think it's worth bringing in is about this trade secret. So right underneath of this trademarks and patents, they talk about trade secrets. And it says here that they own intellectual property, including trade secrets, which they seek to protect in part through confidentiality agreements with employees and other parties. Even where these agreements exist, there can be no assurance that these agreements will not be breached, that we would have adequate remedies for any breach, or that trade secrets will not otherwise become known to or independently developed by competitors. So again, it's an interesting little disclosure about their trade secrets. We do know that there has been quite a few high-level executives that have left the company to go to other automotive companies. So I'm not sure what kind of trade secrets there potentially could be here, as the frame of this vehicle is coming from China on these Class 1 vehicle, and then even the Class 3 cab and chassis. Again, these are Chinese vehicles coming over here. So I'm not quite sure exactly what kind of trade secrets would be needed. And then there's all these patents as well. You could definitely search online and get an idea about exactly what these patents are for. Some of them are for the logos. I'm not quite sure exactly what type of high demand type patents, revolutionary type patents that there are out there. But if you know, again, drop a comment in the chat or comment on this live video later and let me know. Getting into the government regulation credits, they do talk a little bit about the emissions, the ZEV, and we've seen a lot about this. It's been about a year since they have had this HVIP program set up with this voucher system in the state of California. They also got some vouchers in the state of Massachusetts. So interesting again, even with the heavily discounted voucher programs, there doesn't seem to be a very large quantity of vehicles being moved. Again, we'll get to that quantity in a little bit. Going down here, they talk about the EPA, the CARB. Yes, this is an electric vehicle. The EPA and CARB emissions are going to be pretty easy to pass. There's no internal combustion engine in this vehicle, therefore there is no emissions to be made. So congratulations there on the EPA. Moving down into vehicle safety and testing, they do mention that their vehicles do require numerous regulatory requirements established by National Traffic Safety Administration, National Highway Traffic Safety Administration, including United States Federal Motor Vehicle Safety Standards. It says that all Mullen and Bollinger Motor commercial products fully comply with all applicable FMVSS requirements. So interesting. And then it says here, our vehicles are required to comply with numerous regulatory requirements established by the National Highway Traffic Safety Administration. So lots of compliance requirements for the NHTSA, but then they do mention just one, including the FMVSS. So are there any other compliance requirements for the NHTSA that these vehicles do not meet? It's interesting that they use including, and then they only mention at the end that they fully comply with that one inclusion. All right. Moving down to employees. As of the end of this filing, Mullen had 388 full-time employees, which was broken out by 243 Mullen and 145 Bollinger employees. And they do mention that most of them are engaged with automotive engineering, manufacturing, sales, marketing, finance. None of the employees represented by a labor union or subject to a collective bargaining agreement. So again, I have not read that section before on a previous post or a previous filing, I should say. So figured we would go ahead and kind of just talk about that. Getting into this risk factor summary. This is what I believe you should spend a decent amount of time reading through. So we will do just that. I will read the bullets, this bold and italics section, and depending on what that is, we'll either jump into the details or we'll go down to the next one. And again, feel free to read through all of these at a later time if you'd like. So first one, we have incurred significant losses since inception, and we expect that we will continue to incur losses for the foreseeable future, which makes it difficult to assess our viability. We're definitely going to read this section. We have not been profitable since operations commenced, and we may never achieve or sustain profitability. In addition, we have not yet demonstrated an ability to successfully overcome many of the risks and uncertainties frequently encountered by companies in new and rapidly evolving fields such as EV industry. Development and deployment of EV technology in vehicles is highly speculative undertaking and involves a substantial degree of risk. We have only commercialized our EV products and generate revenue from sales of such products on a very limited basis. We have previously devoted, and may continue to devote significant resources to research, development, manufacturing, and other expenses related to our ongoing operations. So again, very interesting, spending a lot of resources on researching these commercial vehicles. Again, there's vehicles on the lot. There's vehicles at Randy Marion Auto. Um, to me, a good amount of resources would be with the sales department, getting these vehicles out there to customers to get them engaged. Uh, Maybe paying the different dealerships a visit periodically to ensure that they are pushing your product. So it's interesting of all the areas to really spend a lot of money, you're going to spend it on engineering, research, and development. Let's continue. We would require significant additional capital to continue operations and execute current business strategy. Mullen cannot estimate with reasonable certainty the actual amounts necessary to successfully continue the development, manufacturing, and commercialization of our products. There is no certainty that we will be able to raise the necessary capital on reasonable terms or at all. We'll talk about that a little bit further down in the filing. They do cover quite a bit about that ELOC agreement, as well as some of the other agreements that they have signed. So again, we'll take a look at that. I did see a very large premium that was paid in order to enact the ELOC agreement, and then what Mullen has actually gotten from the ELOC agreement. If I'm not mistaken, it was actually a lot less, but again, we'll get there. Next section. One sec. Matt K says, so how many is that equivalent before all 5 reverse splits? I lost track. That is a great question there. We'll see if you get a response, and I'll read that out loud. We are an early stage company with a history of losses and expect to incur significant expenses and continuing losses for the foreseeable future. So again, this is covering their basis. They are stating that they will continue to have significant expenses and losses for the foreseeable future. There's no forecast at which point in time they do believe that they will be profitable. So all they can state is that for the foreseeable future, they will continue having losses. We have incurred a net loss since our inception and particularly incurred losses in the operation of its business related to research development activities. Again, we talked about that earlier. It's a lot of money that they're spending for research and development on these vehicles. And we don't really hear a lot about that in these press releases. We heard a little bit, again, as I mentioned, about the one solid state battery testing of the van, just one single video and one single post about that. I would love to hear more about the company's significant expenses in research and development and how it is impacting their future state, as a lot of these shareholders are paying for this. So I think it's important that the company does devout quite a bit of information when it comes to that. Continuing, we believe that we will continue to incur operating and net losses each quarter until at least the time we begin significant deliveries of our vehicles. So significant deliveries of vehicles. They have been delivering vehicles. We'll look at the total number of vehicles delivered. I think really that should have probably said significant sales of our vehicles because deliveries are not sales, according to Mullen's accounting team. Even if we are able to successfully develop, manufacture, and sell or lease our vehicles, there can be no assurance that they will be commercially successful. So again, with all of that research, I still don't know if they're going to be successful in this specific sector. With all the trade shows, with everything that they go to, from commercial events, meeting with different dealers, it's a lot of conversations. That's a lot of opportunity to really understand if your business model has the opportunity to be successful or not. You do have a lot of executives there that spend a lot of time researching the commercial EV industry and the potential sales model. So I find it interesting that they have no assurance that they'll be commercially successful still. We expect the rate at which we will incur losses to be significantly higher in future periods as we, among other things, design, develop, and manufacture our vehicles. So really quick, they paid someone else to design that Mullen 5S that was at that trade show about a year ago at that CES show. Very interesting that they're saying they're spending time doing the design, development, manufacturing of vehicles. And then they mentioned manufacturing of vehicles. Um, if anyone has seen the vehicle lines there at the Tunica facility, I wouldn't call that manufacturing. That's production at the best. Mostly, I would call it assembly. They're taking those vehicles, they're unboxing those vehicles out of those freight boxes or those freight large units, and they're putting a backup camera on there. They're changing some of the logos. Maybe changing one of those god awful looking yellow or red seatbelts to the standard black style. So there's just a couple of things that are being kind of changed over. Something you would think that a third party um, other OEM might be doing. I don't consider that manufacturing. To me, manufacturing is taking that raw material, you know, forming the hood of the vehicle, forming the doors, um, actually welding the chassis together. That is manufacturing. What they're doing is not manufacturing. That's production and uh, more closely related to assembly. But let's continue on. Build up inventories of parts and components for our vehicles. Interesting that they talk about building up inventory and parts. We're going to find out about quite a bit of a loss in revenue and cost of goods sold that they wrote off from aging inventory. But we'll get there. Increase our sales and marketing activities, develop our distribution infrastructure, and increase our general and administrative functions to support our growing operations. We may find these efforts are more expensive than we currently anticipate. I don't think that it could be any more expensive than it already is. We'll look at those expenses for this year as we continue on. Um, or that these efforts may not result in revenues, which would further increase our losses. I mean, that makes sense. If you don't have revenue, but you're still paying people, you'll continue to have losses. Continue on. There is a substantial doubt about our ability to continue as a growing concern. So this statement here is that bankruptcy statement. So again, if the company is to go under, they told you, it was right here. It's in the filing. We'll go ahead and read through this section as well. And we'll get a little bit further down in here as well. They do talk quite a bit about the bankruptcy activities and what would happen, who would be prioritized in the bankruptcy activities as well. So our operating and financial results forecast largely relies on management's assumptions and analysis, which could be incorrect. Whether actual operating and financial results and business developments will be consistent with our expectations and assumptions as reflected in the forecast depends on a number of factors, many of which are outside of our control, including but not limited. So interesting. Quite a bit of items that they don't control. So got a very large staff. A lot of people probably making a decent amount of money in payroll, but can't get your handle around these. So whether or not they can obtain sufficient and timely capital to sustain its growing business. Interesting that we're having a hard time sustaining that. They announced about a year ago that they received significant funding from family office investors, who we found out later was Isusa, and Equitas jumped on there at a later time, also David Rice. So lots of people that were previous part of this Mullen note holders, warrant holder companies, individuals, they're back again. So again, they're obtaining the capital, but what are they doing with it? We'll find out as they break down a little bit of their expenses. I think there's still going to be a little bit of gray area there. Maybe Michelle can help us out there. Um, Reading a little bit further, our ability to manage growth, whether we can maintain relationships with key suppliers, whether we can. And here's one of those typos I said. Whether we can what? Is this a blanket statement? Just whether we can or whether we can't. I don't know. So it's interesting. They were a month late on filing this thing, just about, and still missed some of these typos early on. I'm only on page 24. Our ability to obtain necessary regulatory approvals. Again, you have the CARB, you've got the zero emissions, you've got the quite a bit of those types of approvals. And they already mentioned that the federal highway motor vehicles was already approved, but we'll continue on. Maybe they're talking about one of those other vehicles that they have yet to produce. Demand for our products and services in its target markets. So again, all those pilot programs that they put out, it's very interesting that through all that feedback, through all of those customer trials, that they still don't understand if there's demand for the product and the target markets. Uh, the timing and cost of new and existing marketing and promotional efforts. They did spend quite a bit on marketing and promotional efforts. They'll talk about exactly how much was spent later on in this filing. But remember, they're a EV. They're supposed to be an EV manufacturing company. They're potentially producing and mostly assembling these vehicles. They pay a lot of money towards the marketing and promotional side of things. Competition, including established and future competitors. We saw that most of the ICE vehicles were scrapping out their Class 1 commercial vehicles. So they don't really have that much competition anymore for their specific small vehicle sector there for that Class 1 van. But regardless, it's on here. It's an excuse. Our ability to retain existing key management, to integrate recent hires, and to attract, retain, and motivate qualified personnel. Um, the only way they can really motivate them is it's going to be money. It's going to be shareholder equity funded money. So remember that as you are considering investing. The overall strength and stability of domestic and international economies, regulatory, legislative, and political changes, including tariffs. So it's going to make sense about the tariff situation. They do get most of their imports from China. So I could see how that probably could pose a problem in the near future. They did stockpile quite a bit of inventory. It's been on the previous filings. Um, but what's interesting is the amount of inventory they wrote off after not being successful at selling. But let's continue. Specifically, our operating results forecast is based on projected purchase prices, unit costs for materials, manufacturing, labor, packaging, and logistics, warranty, sales, marketing, and service tariffs, and its projected number of orders for the vehicles. With factors such as industry benchmarks taken into consideration, any of these factors could turn out to be different than those anticipated. Unfavorable changes in any of these or other factors, which may be beyond our control, could materially and adversely affect its business, prospects, financial results, and results of operations. So it's a pretty wide net. So that's a whole lot of potential issues. So again, if any of these stick, they're off the hook. That money that they raised through shareholder equity, it's spent. It can't be recouped. They put it right here in terms of whoopsies, why they were not able to execute as planned. We will require substantial additional financing to execute our business plan, and a failure to obtain this necessary capital when needed on acceptable terms or at all could force us to delay, limit, reduce, or terminate our production operations. We definitely want to read this section here, folks. For the years ended September 30th, 2024 and 2023, we incurred net losses of $505.8 million. This is for this past year, 2024, and $1,006.7 million. That is pretty significant, and that was for 2023. And net cash used in operating activities was $185.6 million and $179.2 million. What I think is interesting is the production / assembly facility there at Tunica. It was scaled up for these vehicles back in September. I think August and September, that was done. So that was a significant amount of capital. I find it interesting that they spent more money this year than they did last year when they should have been using that money towards CapEx expenses to get the facility up to snuff and ready for assembling these Class 3 trucks. As of September 30th, 2024, we had an accumulated deficit of $2.3 billion. That's right, billion with a B. We will need significant capital to, among other things, continue any research and development. Again, they need more than $2.3 billion for the research and development to, again, acquire the vehicles from overseas and do the small amount of retrofitting needed, and then send them to the dealers and then not sell. Again, I think that the money should be spent on really trying to push the product out there, working hand in hand with the dealers. There is one specific salesperson. His name is Jacob Frennings. He seems like he's out there every day. So you got one really good salesperson to cover the entire country. And then there's international sales as well that they said that they were getting into. I haven't really seen much of that, but I want to digress. So let's continue on to this next section here. We expect ongoing capital expenditures in the foreseeable future as we grow our business volumes, including adding new models of our EV products, and that our level of capital expenditures will be significantly affected by user demand for our products and services. The fact that we have a limited operating history, and again, folks, they've been around for about 10 years, but they've only been operating this assembly facility for about a year, which means they will have limited historical data on the demand for our products and services. Again, they did hire an old executive that did commercial EVs. That was Elms, electric last mile vehicle. So it's interesting that they hired a CEO of a commercial EV company who had done a lot of this research when they scaled up that Mishawaka facility originally. I find it interesting that they still have limited operating history, even with some of those team members there, some of those executive team members on their boardroom meetings. So as a result, our future capital requirements may be uncertain and actual capital requirements may be different from those we currently anticipate. We will likely need to seek equity or debt financing. So again, they're going to need some more shareholder equity. They spent the $2.3 billion. We'll see what they've been able to raise so far in terms of revenue and any amount of profit, maybe. We'll take a look. To finance a portion of our capital expenditure. Such financing might not be available to us in a timely manner or on terms that are acceptable to us or at all. So even though they have a bunch of ongoing equity agreements with these family office investors, such as that $500 million ELOC agreement, very interesting that they might not be able to find any financing. Our ability to obtain the necessary financing to carry out our business plan is subject to a number of factors, including general market conditions and investor acceptance of our business plan. That's right. They need you, the investor, to accept their business plan and to continue buying their shares in order to be able to keep operations going. The money is not being invested immediately for any type of potential returns. It's being invested to help pay the payroll for the people that sit behind the scenes as these vehicles sit idle at the lot, at the dealer lot, with very little movement. These factors may make the timing, amount, terms, and conditions of such financing unattractive or unavailable to us. In particular, our current ineligibility to file a registration statement on Form S3 due to our failure to timely file our annual report. So they can't even register the additional shares that they need. They can't even take the investors' money currently because they weren't able to file this 10K on time for the year ending on September 30th, 2023, and our annual report on the 10K for the year ending in September 30th, 2024. So 2 years in a row, they were unable to file. So you think after missing it back in September of 2023, they'd have a whole year to try to figure things out and be able to file this thing on time. They do talk about how they don't have any great any great internal accounting experience, but with all that money, with $2.3 billion, instead of spending so much on marketing, maybe they should spend a little bit more in the accounting department. That's just my thoughts. If they're worried about not being able to continue diluting shareholders because they can't get approval to register more shares. So let's continue. Disruptions in the financial markets and volatile economic conditions could affect our ability to raise capital. If we raise additional capital through marketing and distribution arrangements, again, they're going to market the shareholders. They're going to give you some PR to get you excited to spend more of your hard-earned money so they can have those shares to sell to their investors, who will then generate warrants and sell those warrants. And the shares you just bought will be worth less. But the company will be able to raise that money and be able to continue providing paychecks for those consultants, those marketing individuals, and for those executives that sit behind the scenes. Distribution arrangements and other collaboration, strategic alliances or licensing arrangements with third parties. We may have to relinquish certain valuable rights to our product candidates, technologies, future revenue streams, or research programs or grant licenses on terms that may not be favorable. If we raise additional capital through public or private equity, offerings, the ownership interest of our stockholders will be diluted. So there you go. It's in this forward-looking statement. If you buy their stock, it will get diluted. The value will go down. They're warning you right here, folks. Please pay attention. In terms of any new equity securities may have preferential rights over our common stock and future may restrict our ability to obtain additional financing, even if needed, to continue operations. Further, the ability to fund our needs through equity issuances, warrants, or convertible debt is or may be limited by covenants in certain of our existing or future funding or other agreements. If we raise additional capital through debt financing, we would have increased debt service obligations and may be subject to covenants limiting or restricting our ability to take specific actions, such as incurring additional debt. So, yeah, if you can't pay the first person that you borrowed money from, you probably won't be able to borrow money from another person. It's not going to look good. And typically, you have to sign the contract that says, yeah, we're going to pay you back first. We won't take on any new debt because we want to make sure we can take care of you. We're going to look at how much debt they've incurred compared to the amount of cash that they have on hand as we continue on. Now let's look and see how much money they actually raised through that ELOC agreement. We're going to get there. Again, if we raise additional capital through debt financing, we would have increased debt service obligations and maybe subject to covenants limiting our restrictions. Let me jump down here. Subject to specified financial ratios, any of which could restrict our ability to develop and commercialize our product candidates or operate as a business. Additional capital may not be available when we need it on terms that are acceptable to us or at all. If adequate funds are not available to us on a timely basis, they need you to buy shares on a timely basis. If you don't buy the shares, they will not have the funds. They will go bankrupt. We may be required to delay, limit, reduce, or terminate our establishment of sales and marketing. I don't think they've established sales really. They've had a couple of vehicles be sold. I don't think that they've actually established a very good sales group yet. But marketing for sure. There's a lot of marketing out there, folks. Continuing on, manufacturing or distribution capabilities, development activities or other activities that may be necessary to commercialize our proposed products or other development activities. We might not be able to obtain funding and we might not have sufficient resources to conduct our business as projected, both of which would mean that we'd be forced to curtail or discontinue our operations. So again, let me just reiterate, if you don't buy their shares, they're going to close up shop. It's up to you, folks. They need your money. The next section here, forward-looking statements. We may not be able to raise additional funding nor generate or obtain sufficient cash flows to service all of our existing and future liabilities when they become due. And we may be forced to take other actions to satisfy our obligations, which may not be successful. So I'm going to read through it, but before I do, this is just my take on that specific section there. So they've got to be able to continue raising funds, and that's going to incur additional debt and liabilities. So the kicker is Mullen doesn't have the money to pay their debt. So what do? They'll go to court. They'll get sued by the investors. They'll get sued by these note holders, and then they'll give them shares. They'll find ways to pay them back using whatever amount of market cap has been provided by the retail community. So let's jump into this specific section here. We may be unable, before we do, Zeno, I see you. I appreciate the comment there. Yep, this is my candid take. I'm not holding anything back here. I'm just giving my honest opinion, as well as kind of reading through here. I know it may be a little dry reading through, but I'm trying to pause, between sections here and really just beat down the points that I think are most important, most valuable for investors. So again, we may be unable to obtain alternative sources of financing in an amount sufficient to fund our existing and future liquidity needs. To date, we have yet to generate any significant revenue from our business operations. Yeah, we all know that. Our current working capital and development needs have been primarily funded through the issuance of convertible indebtedness, convertible preferred stock, and common stock. So again, shareholder equity, that's what they're using. That's what they're funding here. It makes sense for a startup, someone who's trying to get in the market, but I think they've had their time. I think it's time to pass, in my opinion. But let's continue reading. I'm not going to give you financial advice, just my personal opinion here. We will need significant capital to, among other things, conduct research and development. So they want some money to do some more R&D, increase our production capacity. I mean, they're not selling what they have. I don't know why they need more money to increase capacity. It makes no sense, folks. But again, that's just my take here. Um, Reading through this section here, expand our sales and service network. So they've got 6 dealers now listed, but they need more money to expand to more locations. Every dealership is another press release, another opportunity to make a splash on any of the investors that maybe they don't know who Mullen Automotive is. Our ability to successfully expand our business will depend on many factors, including our working capital needs, the availability of equity or debt financing, and over time, our ability to generate cash flows from operations. Over time. Is it over months? Is it over years? Is it over decades? I hope it's not over decades. Um, I mean, you are helping a little bit with the overall country's inflation problem because any excess money is being funneled to you for spending. So there's that. Uh, we will need significant capital to, among other things, conduct research. Sorry, I need to jump down here. Our ability to generate cash flows from operations during the 12 months ended September 30th, 2024, the company used approximately 185.6 million of cash for operating activities. So again, they mentioned 2.3 billion over the course of those last 2 to 3 years. But out of that, they use 185 million for cash operating activity. So it doesn't seem like a very good ratio between operating activities and the spend there, folks. The company's principal source of liquidity consists of existing cash and restricted cash, approximately $10.7 million as of September 2024. So they got 10 million cash. Out of all of that, where's the good stewardship with the money? What's going on with the spending? I can't wait for some of the accountants that do review these filings to be able to provide their take. We'll look a little bit into some of those at the end here. The net working capital was negative and reached 120 million. So again, negative 120 million on working capital. If we're unable to obtain funding or refinancing or some restructuring of our obligations or other improvement in liquidity, we may not be able to service all our liabilities when they become due. The company is actively pursuing additional funds. So they've already signed agreements for certain funds, but they're pursuing more funds and remains in discussions with potential financiers. As part of its cost-cutting measures, the company plans to further reduce its workforce, more layoffs, and streamline operations, including downsizing its physical location. So if you did recall a press release, again, maybe 8 months to 12 months ago, they had mentioned cost-cutting measures and about streamlining operations. We'll take a look at their spend from fiscal year 23 to fiscal year 24. Let's see if it really did get reduced significantly or not. Again, our ability to successfully expand our business will depend on many factors, including working capital needs, ability of equity, financing over time, ability to generate cash flow from operations during the 12 months. That's right, 185.6 million. Jumping down to this next section here. The company's principal source of liquidity consists of existing cash and restricted cash, approximately 10.7 million. I mentioned that already. I mentioned this 120 million. I apologize. As I looked up, I briefly lost my place here, folks. Back to this streamlining operations, including downsizing its physical locations. So again, they've got Mishawaka, they've got Tunica. They rent a facility there in Fullerton, and they did have that facility up, I believe, in Michigan, near Detroit area. So downsizing those physical locations, that is where you're supposed to be generating revenue, either through the battery facility at Fullerton, through the Mishawaka facility, which should have been used to assemble vans, but it wasn't, or the Tunica facility, which was being used to assemble vans and trucks. I'm not sure what kind of downsizing opportunities there are. Last photos of the Mishawaka plant showed a ghost town. It didn't look like there was much to keep track of, besides maybe property taxes. Not sure if the utilities were even on, but let's continue. However, there is no guarantee that the company will be able to restructure its liabilities and or secure the necessary financing on favorable terms. Hud Razor, appreciate you joining us tonight as well. If any of our significant obligations are accelerated, we may not be able to repay the obligations that become immediately due and will have severe liquidity restraints. So again, they're stacking preferred convertible notes, senior convertible notes, year over year, and these are coming due. And like they mentioned, they only have 10 million cash. They've got more liabilities. They've got more in accounts payable than they even have cash flow right now, folks, with no plan, no foreseeable plan to be able to raise this money, according to these forward-looking statements, at least. Um, Moving on to this next bullet, we have defaulted on the payments of certain convertible notes, and our failure to comply with the terms of convertible notes could result in an event of default that could materially adversely affect our business, financial condition, and the results of operations. Well, yeah, if you don't pay your bills, you don't pay those note holders that lended you millions of dollars. I would assume as well that, yeah, your operations would be under fire. If there were an event or a default under the senior secured or senior convertible notes that were issued pursuant to a securities purchase agreement dated May 14th, 2024, all amounts outstanding under the convertible notes would be due and payable immediately, which would have an adverse impact on our business, financial condition, and results of operations. An event of default may occur should our assets or cash flow be insufficient to fully repay borrowing under the convertible notes. So again, the thing you need to pay attention to if you are a shareholder in Mullen Automotive right now, they're saying that they're tapped out pretty much. They got that 10 million of cash, but their spend is significantly higher. Um, they have to pay these convertible note holders before any normal shareholders. So in the situation of bankruptcy, all the assets will be sold. Those properties, anything of any value, any inventory, it's going to be sold, it's going to be liquidated. And these senior convertible note holders who have already been getting significant amount of interest that's been due, that they have inadvertently gotten additional shares for, they're going to be the first ones to cash out on any of the liquidity left in Mullen Automotive, whether paid in the ordinary course or accelerated, or if we are unable to maintain compliance with the relevant obligations, thereunder, including financial and other covenants, various risks and uncertainties may impact our ability to comply with our obligations under the convertible notes. As of September 30th, 2024, so the end of their fiscal year, we had an aggregate amount of approximately 20.3 million of senior convertible notes that were issued pursuant to the securities purchase agreement. As of September 30th, 24, convertible notes were in cross default, as the company had not paid a part of the notes that matured during the September 2024. As a result, interest rate of convertible notes was increased from 15% to 20%. So if you recall, there was quite a few investors that were at least happy about the interest rate that they got on some of these notes. Well, they didn't pay them, so the interest rate's already been increasing. Whether paid in the ordinary course or accelerated, sorry, folks. Down here, although the investors could request immediate payment in cash, the investors did not demand payment. In December of 24, a settlement agreement between company and holders of the notes was approved by a court, and as of the date of this report, almost full amount of convertible notes, including a cumulative interest, has been converted to shares of common stock under the Securities Act of 1933. Excuse me. So, just so you're aware, they're unable to pay their bills. And because they couldn't register any additional shares through an S3 filing, they took it to court and they got court mandated approval to be able to convert to common shares. Our inability to comply with any of the provisions of convertible notes could result in a default, which would permit the holders declare the principal amount and accrued interest immediately due and payable and exercise any or all of its rights, powers, or remedies under the convertible notes or applicable law or available in equity. So again, they've got first dibs. If there's any issues at all, they will get all of the money. There will be nothing left. That is my main concern for shareholders that are very frustrated and maybe seeking class action lawsuit. There's not going to be anything left of the company if they go bankrupt. It will be tapped out. It will be completely sold off, whatever's left, to these convertible note holders. So the best way to get a class action lawsuit is probably going to be more of a civil type class action lawsuit to go over the people that really have taken your money with these false promises that are disguised as forward-looking statements. Again, my opinion, just be cautious out there. These people are trained professionals. They've been doing this for many years. They know how to stay compliant. They know the right words. They know the terminology necessary to be able to stay compliant with the SEC. But by all means, if you are very frustrated, there's at least an opportunity, an option that you could pursue. Jumping down, our inability to comply with any of the provisions of the convertible note could result in a default which would permit the holders declare the principal amount, accrued interest immediately. I read all that. Available in equity. Plus, as security for payment of the amounts due and payable under the convertible note, the company granted a continuing security interest in all of its right, title, and interest in its assets, whether owned, existing, acquired, or arising, and wherever located. So there you go. It's right there in this forward-looking statement. They're going to hand over every last bit of old assets and any future assets. So I would be cautious getting too excited about any future press releases where they potentially have received more vehicles or testing maybe a new class vehicle. Remember, these secured note holders, they own the company. They own the CEO. The CEO works for them, not the other way around. So I hope that they realize that. And I hope as the shareholder, you know that too. If we're unable to repay outstanding borrowings when due, the holders also have the right to proceed against the collateral. The occurrence of any of these events could have a material adverse effect on our business, financial conditions, results of operations, and liquidity. Well, yeah, if you don't pay your bills and they come to collect and they collect all your assets, I would say that your business is probably in trouble. Due to the uncertainty about our ability to obtain sufficient cash to service current and future liabilities, there is risk that, among other things, third parties' confidence in our ability to develop and manufacture, explore, produce electric vehicles, which could impact our ability to execute on our business strategy. It may become more difficult to retain, attract, or replace key employees. It's going to be very difficult because most of these employees are going to have to sign that non-disclosure agreement. And then they will become accessories to whatever's going on internally with the company. As many of these PRs, they get exciting. They look very exciting, very promising for an investor, but not a whole lot of actions to follow through on. Our suppliers, vendors, service providers could renegotiate the terms of our agreements, terminate the relationship with us, or require financial assurances from us. Yeah, they probably won't be providing you any equipment, any materials without payment up front, especially if they know anything about your balance sheet. And I would say that a lot of times, whenever um, there are some new vendor agreements, if the company trying to sign a contract with a specific vendor is a publicly traded company, one of the first things that those vendors will do is look up the filings. They want to understand what the financial condition is of this specific company before doing any business with them. So I would agree that it may be difficult for Mullen Automotive to find vendors that are willing to do anything up front without getting paid full in cash. I don't think that they're going to have very good luck with a net 30, net 60, net 90 term. Again, this is just my opinion. Seeking bankruptcy court protection could have a material adverse effect on our business, financial condition, results of operations, and liquidity. Let me repeat that again. Bankruptcy court protection. They're going to go into a little bit of details on this section here. So we've already heard about their ongoing concerns about continuing, and now they're talking about bankruptcy court protection. For as long as a bankruptcy proceeding continued, our senior management would be required to spend a significant amount of time and effort dealing with the reorganization instead of focusing on our business operations. I mean, I would love to hear, an update for shareholders on your business operations and all the time you spent this last year. What's that amounted to? What type of relations have you won and acquired? Uh, how many of those pilot lot programs were successful? Did you at least sell one vehicle to a large company after piloting to try to gain their um, customer reputation, or to gain their trust and potential sales in the future? I don't know. I've yet to see that. Um, Bankruptcy court protection also could make it more difficult to retain management and other key personnel necessary to the success and growth of our business. It's difficult to keep a career with a company who's filing bankruptcy court protection. So I can understand that. In addition, during the period of time we are involved in a bankruptcy proceeding, our customers and suppliers might lose confidence in our ability to reorganize our business successfully and could seek to establish alternative commercial relationships. Pretty sure they're already doing that. And the occurrence of certain of these events has already negatively affected our business and may have material adverse effect on our business results of operations and financial condition. One moment. Next section, we have identified material weakness in our internal control over financial reporting. This is the part I was talking about their accounting condition. Failure to achieve and maintain effective internal control over financial reporting could result in our failure to accurately or timely report our financial condition of results or result of operations, which could have material adverse effect on our business and stock price. Yeah, because the financial reporting is what's impacting the stock price. The lack of material in this financial reporting. I think it's probably the dilution. I think it's probably the conversion of shares and warrants that are impacting the stock price. I wouldn't blame it on the material weakness in the accounting, but that's just my opinion. Because even with the information that's being shared, it doesn't look great for investors. But let's continue. A material weakness is a deficiency or a combination of deficiencies in internal control over financial reporting, such that there is reasonable possibility that a material misstatement of our financial statements will not be prevented. So someone might make a mistake. They might add an extra zero on a revenue line or a profit line or miscalculate something, and it's in the forward-looking statements. They're covered. And they don't actually have someone internally doing this. They can just blame it on whoever is hired to do the job. You get the finger point. Um, Material misstatement of our financial statements will not be prevented or detected on a timely basis. Our management has concluded that our internal control over financial reporting was not effective as of September 30th, 2024, due to material weakness such as certain policies and procedures that are not all formalized in a written procedure format that is up to date, absence of formalized review of key control processes, and or insufficiently formalized documentation evidencing certain design deficiencies in management and analytical review of controls associated with financial close process. Lack of in-house accounting expertise. So that's the part I'm talking about. So unless they're using, secretary without an accounting degree to take a look at the books, um, they're saying they have a lack of an in-house accounting expertise. So not that it's non-existent, they just don't have the expertise for it. So they're amateurs. And a lack of disclosure controls and procedures to ensure the company properly presents certain related party disclosures. And again, if you're familiar at all with Mullen Automotive's previous filings, this has always been an issue. And that's why I said earlier, why would the company not invest a little bit more money into financial situation when they're accounting to make sure that they're set up for success, that they really understand how much money they've burned each month instead of spending more money on consultants, on marketing team members, and on additional salespeople that have yet to provide a significant impact on the bottom line for the company. We may not be able to fully uh, remediate, any future material weaknesses until these steps have been completed and have been operating effectively for a sufficient period of time. If we are not able to maintain effective internal control over financial reporting, our financial statements and related disclosures may be inaccurate, which could have materially adverse effects on our business and on our stock price. Any failure to maintain internal control over financial reporting could severely inhibit our ability to accurately report our financial condition or results of operations. So does this cover the press release when they state a certain amount of vehicles have been sold? A certain amount of revenue has been generated, but then this financial reporting doesn't show that. So it doesn't really make much sense. And yeah, Matt K, I 100% agree. I feel that Mullen should tank on this. So unless there's something kind of shiny and distracting to offer naive shareholders, I don't see very much positivity from what I've read so far. But again, I want each of you to take this information, really internalize it, and make the decision yourself. I'm not trying to persuade anyone. I'm just trying to get through the filing and talk about the history of the company and what they've done so far, in my opinion. So let's move down into this next section here. Commercial vehicle sales depend on affordable interest rates and availability of credit for vehicle financing. Any substantial increase in interest rates could materially and adversely affect our business prospects, financial condition, results of operations, and cash flows. I'm not going to read this section here. Interest rates might change on vehicle sales. People may not be interested. I mean, even with the voucher program, with a significant reduction in price of vehicle, people aren't interested. So, not really sure that a little bit of percentage will really be impacting. And these are commercial vehicles. So, a lot of times, some of these commercial companies will pay cash or they'll just write off that interest. So, not really sure how large of an issue that really is, but I digress. We incurred non cash impairment charges during 2024, which adversely affected our year fiscal 24 operating results. And we may be required to incur additional future impairment and other charges which could adversely affect our operating results. Let's see exactly what those impairments are. In connection with our acquisition and other business combinations, including our acquisition of Bollinger Motors in 22, applicable accounting standards require the net tangible and intangible assets of the acquired business to be recorded on our consolidated balance sheet at their fair values as of the date of acquisition, and any excess in purchase price paid by us over the fair share of net tangible and intangible assets of any acquired business to be recorded as goodwill. Goodwill and indefinite lived intangible assets are not amortized, but are tested at least annually for impairment or more frequently as events and circumstances dictate. Goodwill is tested for impairment at the reporting unit level, which is generally an operating segment or underlying business component. Indefinite lived intangible assets are tested for impairment at the individual indefinite lived intangible asset group. Finite lived intangible assets other than goodwill considered long lived assets for impairment testing purposes. I'm not going to break this down. This seems like a lot of jargon here. If anyone can break this down, please do that in the chat or in the comment section. I'm going to go ahead and jump down to the next paragraph here. If we determine that the anticipated future cash flows from our reporting units, indefinite lived intangible assets or asset regroups, or long lived assets groups may be less than their respective carrying value. So, yeah, they pay too much for these assets. So, they're going to write off a significant amount of those assets. We're going to see where they wrote off inventory and raw materials as well as we continue on looking through this filing. Our goodwill indefinite lived, if this incurs, applicable accounting rules may require us to write down the value of the goodwill indefinite lived intangible assets and or long lived assets on our balance sheet to reflect the extent of any such impairment. Hamill will assemble cheap, outdated Chinese vans for capital. Give me a break. I agree. I agree. And you're going to see Kyle later on in this filing. Those cheap, outdated Chinese vans, they've been written off. They took a significant reduction in value. They wrote it off in the COGS. So we'll take a look at that. Any such write-down of goodwill, indefinite-lived intangible assets, or any long-lived assets would generally be recognized as non-cash expense in our financial statements for the accounting period during which any such write-down occurs. Impairment losses recording during the 12 months ended September 30th, 2024, amounted to $119.2 million. Wow. So what they're saying is they overpaid. Again, that $2.3 billion of shareholder equity, they're frivolously spending it on these locations for that PR pump. And now they're just writing off large chunks, millions of dollars, hundreds of millions of dollars in impairment costs because they can, as long as it's written in the filing. This is where they can dump some of their losses. Looking back on September 30th of 2023, fiscal year 23, their impairment amounted to 84.6 million. So again, between these 2 years, they've written off just about $200 million worth of overspend on assets. Again, I do think it's rather important that they find themselves a accountant or a financial person, a CFO, that can really evaluate some of this capex before they just throw money at it. I know it's not their money, it's shareholder money. It doesn't hurt them. It never belonged in their pocket to begin with. It belonged in each one of your bank accounts. But you gave it to them, hoping for a squeeze, hoping for a 10x on your investment. Because a large chunk of the stock market is a gamble. That's what it is. Call it what it is, folks. You gambled on this company and you lost. I lost. Many of us lost. Moving down, our financial results may vary significantly from period to period due to fluctuations in our ongoing operating costs and other factors. So yeah, they've got to continue paying the marketing team. The press releases are expensive, folks. That's where the significant amount of costs are coming. So instead of hiring engineers, they're probably looking for writers. Maybe people who were part of the newspaper club in high school. They would fit right in at Mullen Automotive, as long as they can write those press releases. We expect our period to period financial results to vary based on our operating costs, which we anticipate will fluctuate as the pace at which we continue to design, develop, and manufacture. Again, they're using that term manufacturing so loosely. At best, produce, closest to assemble new products and increase production capacity by expanding our current manufacturing facilities. How are you going to expand the facilities? You got $10 million cash. You owe all of your senior convertible note holders a lot of interest that you're already late on. So don't spend any more shareholder money on expanding. Spend it on finding additional people or any competent person to be able to really sell the inventory you have. I digress. As a result of these factors, we believe that quarter to quarter comparisons of our financial results, especially in the short term, are not necessarily meaningful, and that these comparisons cannot be relied upon as indicators of future performance. They're basically saying, don't look at our previous quarters. Don't look at all that loss. Don't look at that $2.3 billion that we squandered. Let's talk about the future. Let's take a look at that next PR. Moreover, our financial results may not meet expectations of equity research analysts, ratings agencies, or investors who may be focused only on short-term quarterly financial results. Well, yeah, most investors, if you're going to spend your money, you're going to want to see a return or at least be able to extrapolate a couple quarters to understand if that investment is going to, relate in any gains for you in the future. So quarterly earnings reports, that's really the most important area to get your due diligence and facts from. Don't pay attention to the press releases, folks. Pay attention to these filings. If any of this occurs, the trading price of our stock could fall substantially, either suddenly or over time. Well, yeah, it makes sense. It probably would fall substantially over time when you put out a quarterly filing with little to no revenue and a significant cost of operations. We have not paid cash dividends on our current stock in the past and do not expect to pay dividends on our current stock in the future. Yeah, you can't pay your secured convertible note holders, senior convertible note holders. Um, why would you pay your shareholders any dividends? So, fair played. We may not be able to maintain compliance with the continued listing requirements of the NASDAQ capital markets. Well, again, maybe pay a consultant a little bit of money since you like to spend money anyway, and really focus in on how to make sure you maintain those NASDAQ requirements, like filing your 10K on time. You know, this is dated from September 30th. Seems like 3 months is a decent amount of time to be able to put together a filing like this. Um, you didn't have many receipts to really comb through, at least when it comes to revenue and sales. But I digress. I'm not going to read through this section. We all know that they have a hard time maintaining compliance, and it's not because of the amount of shorts. It's because they're selling their market cap to these secured note holders with warrants attached, which significantly dilute the share price down under $1. And then they end up falling out of NASDAQ compliance, which results in more reverse splits. So you have to ask yourself, at what point in your investment journey do you realize that there's really nothing left here? Again, in my opinion. Let's continue down. Speaking of reverse stock splits, a reverse stock split may decrease the liquidity of the shares of our common stock. I don't know why they say may decrease the liquidity. When you reverse split, if it's 1 for 100, right now they're at 60 million shares. So it's going to put them around 600,000 shares. So yeah, there would be less shares, especially less shares on loan. Anyway, it may have a dilutive effect on the ownership of existing stockholders. Well, yeah, it probably will because a lot of those um, executive and other employee uh, share programs are not impacted by this reverse stock split. So yeah, as these employees are being paid through shares, maybe it would have a dilutive effect on current shareholders. Not going to read through the rest of this liquidity. If you're not familiar with reverse splits, go ahead and take a look at this section here on page 30. Following a reverse stock split, the resulting market price of our common stock may not attract new investors, including institutional investors. Yeah, probably not. And may not satisfy the investing requirements of those investors. Yeah, investors typically don't want to invest in penny stock companies. Consequently, the trading liquidity of our common stock may not improve. Hopefully not, in my opinion. And then they talk about how the common stock may be subject to penny stock rules in the future. I think rules are good. I think rules are helpful. I think they protect shareholders. I'm all about rules. It may be more difficult to resell securities classified as a penny stock. That's true. So hopefully there can be ways to avoid penny stocks. We may issue additional shares of common stock, including under our equity incentive plan. We're just talking about this, and our commitments to issue shares of common stock or securities that are convertible into shares of common stock, aka warrants, may cause significant dilution to stockholders and present other risks. We may issue a substantial number of additional shares of common stock. Well, if anyone's been following the number of shares issued by Mullen Automotive, it's not at a Guinness World Book record, but it's probably up there in at least like 50, if not top 20. Reading on May 14th, 2024, we entered into a securities purchase agreement with certain investors Pursuant, we issued an aggregate principal amount of $52.6 million of 5% original issue discount senior convertible notes with 5-year warrants. That's that dilution number. That's that dilution where they're warrants. 4 shares of common stock. Furthermore, the period ending July 9th, 2025, the investors have the right but not obligation to purchase an additional $52.6 million of notes and related warrants on the same terms and conditions as provided in the SPA. So again, these same investors that have been purchasing shares with warrants attached and selling back to the open market, they've got plenty of additional ammo for the period ending July 9th, 2025. The outstanding principal and accrued but unpaid interest on the notes may be converted by the holder into shares of common stock at a lower of $549. So if they do the 1 for 100, that would be, wow, that is a very large number. If we're sitting at 50 cents, 1 for 100, it's only going to get you to $50. Wow. Anywho, 95% of the closing sale price of the common stock, I think this is just because of it's already undergone a reverse split before. So this specific number back on May 14th of 2024 has already been split adjusted. On the date of the initial registration statement, it is declared effective, or 95% of the lowest daily volume weighted average price in the 5 trade days prior. And here is your conversion price. It won't be less than $1.16 per share. That is so helpful. So glad that they can convert less than $1.16 per share. Warrants are exercisable for 200% of the shares. So yeah, you can exercise that convertible note for $1.16 a share, but you will get 2 extra shares. So buy 1 share, get 2 warrants free, and you'll have plenty of opportunity to dilute existing shareholders. Again, warrants are exercisable for 200% of the shares of common stock. Underline the notes at an exercise price. So we're talking about the notes again. Underline the notes at the exercise price of $549 and may also be exercised on a cashless basis, which again, we know the cashless basis is just more shares pursuant to their terms. Finally, on December 12th, 2024, the company and certain investors entered into an additional investment rights agreement whereby for a 1-year period ending December 12th, 2025, such investors have the right but not obligation to purchase from the company additional notes in an aggregate principal amount of approximately $4.6 million and related warrants on the same terms and conditions as provided in the SPA. So again, they increased the amount of shares for this SPA back on December 12th, 2024. Let's keep going. In addition to the company's equity incentive plan, again, paying those employees and executives, the company has also adopted the 2022 CEO Award Incentive Plan, approved by the board and by stockholders in 2022. And not mostly retail stockholders. We're talking about a lot of these larger convertible note type holder investors were the ones that most likely helped approve this CEO Award Incentive Plan. And the 2023 CEO Award Incentive Plan, approved by the board and by stockholders in 23. Under these plans, the chief executive officer is entitled to share-based awards, generally calculated as 1 to 3% of the then outstanding number of shares of common stock, issuable upon achievement of specific financial and operational targets. Again, I think it's really important that we hold the CEO accountable for those financial and operational targets. We want to see the actions. We want to see the value brought to the company, not just an activity on a PR that justifies that award, but actual sales, actual revenue being generated, actual activities that bring that EPS number that are supposed to significantly increase value of the company. Total shares of common stock to be issued under the plans will depend on the ability of the milestone achievement and on the number of shares of common stock outstanding on the day the milestone is achieved. I talked a little bit more about executive compensation. Let's focus on the company, not on the CEO for now. I'm going to go ahead and skip this section. Oh, this is about the ELOC. Let me take a second here. May the issuance of additional shares of common stock or issuance of shares of common stock upon the conversion of notes and exercise of warrants or upon sales pursuant to the ELOC purchase agreement may significantly dilute the percentage of ownership and equity interest of holders of our common stock. Yes, exercising warrants, converting notes, and some sales from ELOC most definitely could have dilutive ownership of holders of their common stock. Dilute the book value per share of our common stock. Yeah, you're adding to the pot of the same market cap. It's going to dilute the book value. Could cause a change in control if a substantial number of shares of our common stock are issued, which may affect, among other things, our ability to use our net operating loss carry forwards, if any, and could result in the resignation or removal of our present officers and directors. Can you make it the chief executive officer? That would be glorious. And increase the number of our publicly traded shares, which could adversely affect prevailing market prices for our common stock and depress the market price. Next section, stockholder equity interest may be substantially diluted in any additional equity issuances. Yes, stockholder equity would be substantially diluted. Our commitment to issue shares of common stock pursuant to the terms of our preferred stock, notes, and warrants and stock-based compensation could encourage short sales by third parties, which could contribute to the future decline of stock price. I mean, they're just jumping on when they see the amount of warrants that are being issued. You can do the math. It's going to pull the price down. So if you want to invest to make money, take a look at these filings. Take a look at the financial agreements. Which direction will it go? Sure, there are some days where the stock price may spike, and that's most likely due to these investors purchasing these initial notes. But with every purchase note, there's 2 warrants being applied. So please be cautious when purchasing stocks if you're considering going long in a circumstance like this. Let's jump down. I think I've beat up on this section about short sales and future declining of stock prices. Sale or issuance of our common stock pursuant to the ELOC purchase agreement may cause dilution in the sale of the shares of common stock, or the perception that such sales may occur could cause the price of our common stock to fall. I said 500 million. I apologize. It's 150 million. That's how much this ELOC agreement was. But this is actually really, really important. Please key in on this next paragraph here, and then we'll talk a little bit about it. On May 14th, 2024, the company entered into this ELOC purchase agreement to which the investor agreed to purchase from the company at the company's direction from time to time, in its sole discretion until earlier on the 36-month anniversary of commencement, termination of ELOC purchase agreement, with the shares of common stock having a maximum aggregate purchase price of 150 million upon the terms subject to conditions of liability. So here's the section, here's the details that you really need to focus in on. In connection with the ELOC purchase agreement, the company also entered into a registration rights agreement pursuant which the company agreed to file a registration statement and any additional registration statements with the SEC covering the resale of the shares of the company's common stock issued to investor pursuant to the ELOC purchase agreement. Here you go. In August and September of 24, so in these 2 months, the company issued 247,000 shares as commitment shares. So they gave this investor, Isusa, who signed this ELOC purchase agreement, they gave them 247,000 shares, almost 248,000 shares, just as a commitment for signing this ELOC. So think about that. A chunk of the market cap was given to this company just for signing the agreement. Let's see what they've done so far with this agreement. On October 24th, 2023, and look here, folks, another typo. Come on, get it together, Mullen Automotive. This should be October 24th, 2024. The company issued 502,066 shares of common stock with proceeds approximately 1.1 million. So out of 150 million of this ELOC agreement, the company has managed to raise 1.1 million. But wait until you see how much interest and what the cost was to initiate this ELOC agreement with Isusa, because it's in this filing and I've read it, and we will too together. The company can continue to access the ELOC if it files another registration statement with the SEC. Yeah, it needs to register more shares. The purchase price for the shares that we may sell under the ELOC purchase agreement will fluctuate based on the price of our common stock, depending on market liquidity at the time. Such shares may cause the trading price of our common stock to fall. And this talks a little bit more about some of the details behind the ELOC purchase agreement. Let's go down here. Substantial blocks of our total outstanding shares may be sold into the market if there are substantial sales or issuance of shares of our common stock. The price of our common stock could decline. That is true. That is true, especially with all of the way these contracts are written, that these companies are able to purchase all of these shares at a discount of whatever that current market pricing is. So it would make sense that as they're purchasing and gaining equity themselves, they're diluting the rest of the. Oh, I'm sorry. They're creating a decline in stock price, which actually gives them more shares on the back end of that. So that's an interesting take. Again, as of January 21st, 2025, we had outstanding 61,595,743 shares. And they talk a little bit about the market price of shares of our common stock could decline as a result of sales of substantial number of shares of common stock in the public market. So again, they're talking a little bit more about the subject line here. I'm going to continue on. We're almost through this, and then we get into the fun part, the money part, and some of the explanations behind the spend. So if you bear with me through this section, I would say it will get better, but it just depends on your sense of humor, I suppose. Talk a little bit more about exercising of warrants, how that can impact share price. Again, it's a warning sign. It's letting the investors know the company is no longer liable for any losses to investors because it's all written right here in these um, forward-looking statements. Our stock price has been volatile, and the market price of our common stock may drop below the price you pay. Yeah, I would say that that's pretty probable, especially after looking at these filings and just knowing the history of the stock and all of these existing agreements, these security purchase agreements, these ELOC agreements, all of them um, can create some significant issues. Yes, there are day traders that may get lucky. They may be able to pull out a win on this, but if you hold this stock for more than a week, more than a week and a half, there's a good chance that you've already lost money. So, not going to go through all this section, but yeah, there's a good chance that your money, um, you will take a loss on your money. All of our debt obligations and our senior equity securities will have priority over our common stock with respect to payment in the event of liquidation. Oh, this is great. I remember this part. In the event of liquidation, dissolution, or winding up. And our outstanding senior securities restrict our ability to pay dividends on our common stock. So yeah, even if they wanted to be able to pay these poor shareholders that they've diluted into, they got to pay these debt obligations to these senior secured note holders first. So again, they're going to get any of the any of the value before the common stockholders do. If we were to liquidate, dissolve, or wind up, our common stock would rank below all debt claims against us and claim of all our outstanding shares of preferred stock. As a result, holders of our common stock will not be entitled to receive any payment or other distribution of assets upon the liquidation, dissolution, or winding up of the combined company until after all our obligations to our debt holders have been satisfied and holders of senior equity securities have been have received any payment or distribution due to them. So again, although as the shareholder for the past few years, you were the thing that kept the lights on. You're the reason why they were able to take that paycheck home each night. You were the reason why they were able to even offer these senior secured convertible notes to these investors. It's because you've provided that market cap liquidity. So it's very unfortunate that people who paid into this market cap are the last people that will get a dime from it. Moving on to the next section. Our certificate of incorporation designates specific courts as the exclusive forum for certain stockholder litigation matters. So, yeah, if you choose to sue Mullen Automotive, make sure you do it in the right court setting, which could limit the ability of our stockholders to obtain a favorable forum for disputes with us or our directors, officers, or employees. So, yeah, they're kind of warning you. If you try to sue us, you're going to have a tough time. So, again, go ahead and read through all this if you are kind of considering any type of litigation. It's good to note, it's good to read through this. If securities or industry and analysts do not publish research or reports about our business or publish negative reports about our business, our share price and trading volume could decline. Yeah, if for some reason Global Wire decided that they no longer want to support Mullen Automotive and publish their press releases that they provide them, they're going to have a hard time generating any capital because shareholders are not going to know what's going on. And yeah, a lot of analysts that read these quarterly filings and who hold Mullen accountable for their press releases probably will put out some negative content about the company. But if it's true, it's still valid, it's still important. Continuing on, we have a limited operating history. Again, they were formed in 2010, 15 years ago. Have not yet manufactured or sold a significant number of vehicles to customers. JCAS, appreciate that. I will continue on. And have limited experience in high volume manufacturing of commercial EVs, all of which makes evaluating our business and future prospects difficult for potential investors. They were formed in 2010. They went public in 2021. So 11 years to really do your homework before going public. They still have limited history. They hire people from the automotive industry, some in the electric automotive industry, some in the commercial electric automotive industry, but yet they have limited operating history. I find that disturbing. In addition, as a result of our limited operating history as well as limited financing, seems like they've gotten plenty of financing through equity over the past few years. We have received, our management concluded that there was a substantial doubt about our ability to continue as a going concern. Yeah, they're stating here they lack experience, they lack opportunity for additional funding. They're saying that there's a good chance that they're going to go bankrupt. Their ability to continue is a going concern. As we transition from research and development activities, and please, dear God, please transition from this. This is a huge, huge cash burn for your poor shareholders that have been buying in on your stock on every one of these PRs. Research and development activities to commercial production and sales. It is difficult, if not impossible, to forecast the future results, and we have limited insight into trends that may encourage and affect our business. The estimated costs and timelines that we have developed to reach full-scale commercial production are subject to inherent risks and uncertainties involved in the transition from a startup company. Again, 15 years, still a startup. There's plenty of people that open a business, entrepreneurs within 1 year, find themselves on Shark Tank, and they're a rapid success. Mullen Automotive, they've at least got their name out there. They've gotten quite a bit of notoriety among retail investors. Difficult to still call them a startup company, but from an experience standpoint, I guess you can continue being startup. Focus on research and development activities to large-scale manufacture and sale of vehicles. These are complex processes that may be subject to delays. Hire some people that understand this, please. Cost overruns and other unforeseen issues. For example, the tooling required within our facilities may be more expensive to produce than predicted. I mean, you can get a quote, you can get multiple quotes, and then you pick the one that has the best price. It's really not that difficult. But anyway, that's just manufacturing 101. Um, or have a shorter lifespan, resulting in additional replacement and maintenance costs. Yeah, those wrenches used to assemble those two vehicles, they might wear out, but the amount of wrenches turned at your facility, I think you've got a couple years left of life still in those wrenches there, which would have material adverse impact on a result of operations and financial condition. Again, if you look at the cost, the spend of operations at 180 million compared to the 2.3 billion dollars, we'll look at exactly what this one fiscal year came out at. I don't think it's the cost of operations that's really burning down the house there, guys. We cannot assure that we or our partner will be able to develop cost efficient manufacturing capability and processes and reliable sources of competent supplies that will enable us to meet quality, price, engineering, design, and production standards, as well as the production volumes required to successfully manufacture its electric commercial vehicles. You should consider our business and prospects in light of the risks and significant challenges we face as a new entrant, new meaning 15 years old, into the EV industry, including, among other things, with respect to, and here's a full list. I really don't want to read through this. I want to get down into the details here. But again, um, read through this is everything that they're saying that they're terrible at doing. If we fail to adequately address any of these risks and challenges, our business may be materially and adversely affected. In addition, there can be no assurance that fleet managers will embrace our products in significant numbers. I can agree with that. Market conditions, many of which are outside of our control and subject to change, including general economic conditions. The general economic conditions would be if we go through a recession and the shareholders don't have that extra pocket change to buy your 50-cent shares for, you could end up not being able to raise that extra capital. The ability in terms of financing, energy prices, regulatory requirements, existence, and robustness of government incentives, competition, and the pace and extent of vehicles electrification generally will impact demand of our electric commercial vehicles and ultimately our success. So yeah, all of these are the potential issues of why you're not successful at selling these vehicles. Pretty sure you could travel to a used car lot and ask them the number of vehicles sold each month, and they don't travel around. They don't provide pilot programs for those people. And a lot of them don't provide massive vouchers either. But yeah, it's interesting to use these as excuses. All right, potential acquisitions may disrupt our business and dilute stockholder value. During the calendar year quarter of 2022, third calendar quarter of 2022, they acquired a controlling interest of Bollinger Motors. They acquired a significant part of the assets of Elms Last Mile Solutions. So yeah, their commercial sector they acquired back in 2022 during the third calendar year of 2022, both Bollinger and Elms. In September 23, they acquired assets of Romeo Power. Now, those battery um, machinery equipment that we saw them move into that Fullerton location still had the sales. It still had the auction tags on them throughout the videos. To me, that's kind of amateur hour. I would at least take off the auction tags after a couple months if you're trying to say that you're trying to open up a battery manufacturing line. We will continue to identify and analyze merger or acquisition partners that are culturally similar and have experienced management and possess either significant market presence or have potential for improved profitability through financial management, economies of scale, or expanded services. Acquiring related electric vehicle businesses involve various risks commonly associated with acquisitions, including, among other things, exposure to unknown contingency liabilities, and let's not forget the amount of impairments that they took for overpaying for these things. Exposure to potential asset quality issues of the target entity. Yeah, if you're the only one putting a bid on an asset, it might be a problem. A difficulty and expense of integrating the operations and personnel of the target entity. Yeah, you've got to pay integrators to go in and get your assets up and running. You can't have one person there just talking about the equipment and expect the equipment to start working. It takes a group of engineers and integrators to do that. Potential disruption to our business, potential diversion of our management's time and attention. I mean, I don't know what else the manager should be spending time on if it's not getting these expensive assets that were just purchased up and running to generate profit. Difficulty in estimating the value of the target entity and potential changes in banking or tax laws. Appreciate you sticking around, HUD Razor. Yes, this is definitely not a speculative play, in my opinion, either. And appreciate the support here. We'll have this full video if you want to hear about the financial results of it at a later date. So, and again, they regularly evaluate merger acquisition opportunities and conduct due diligence activities related to possible transactions with other businesses. I'm going to go ahead and skip the rest of this paragraph here. Yeah, they could overpay, they could underdeliver. We may be unable to develop and manufacture commercial EVs of sufficient quality to appeal to customers on the schedule they expect, or may be unable to do so on a large scale. Yeah, that's true. So here's all the reasons why they potentially could run into issues on developing and manufacturing commercial vehicles. Again, all these vehicles that they are assembling are out of the box. It's like buying something from IKEA and putting it together. It's not a whole lot to it. And a lot of these have already been tried and true overseas. But yeah, I can see them having a hard time developing and manufacturing their own commercial EVs to a quality that customers would like. That was some of the gripe. Some of the customers said that the seat in that class one was pretty tight, pretty uncomfortable for a large person over 6 foot. But anyway, I digress. Going down here, we are dependent on certain principal suppliers and vendors in China for a significant portion of our vehicle components. So there you go, folks. For any of those doubters out there, the majority of these vehicles are coming from China. And the inability of these vendors to deliver necessary components of our products according to our schedule and at a price, quality levels, and volume acceptable to us, or our inability to efficiently manage these components. I don't know how they would have an inability to efficiently manage, considering they have a person in charge of the division of international sales and relations there in China. But I digress. Could have material adverse effects on our financial condition and operating results. So yeah, if they can't continue procuring these vehicles from China, it could have an impact on the results. But again, they procured plenty of vehicles from China. They had them shipped to these various dealerships. So I think that's just a secondary issue. Moving on to the next, our vehicles will make use of lithium ion battery cells, which have been observed to catch fire or vent smoke and flame. And if such results occur, bodily injury or death could result and could be subject to lawsuit, product recalls, and redesign efforts. So that's a great question. Are these electric vans and trucks? Are they really just these hoverboards that get plugged in and catch fire in people's garages? Is there a significant issue with these vehicles that would really put a dampening on a commercial company wanting to use them? Has there been any vehicle fires during the pilot lot programs of these vehicles? All interesting details that we will not be privy to. The cells used in the EV battery modules degrade slowly over time, influenced primarily by the age of the cells, especially when sitting in Randy Marion's lot for so many months, and the total energy out throughput over the life of the EV. The cell degradation results in a corresponding reduction in the vehicle's range. Although common to all EVs, cell degradation and the related decrease in range may negatively influence potential customers' EV purchase decisions. Yeah, you don't want to buy a cheap, you know, marked down battery that's going to potentially fail in a short period of time. We are substantially reliant on our relationships with a limited number of OEMs, suppliers, and service providers for parts and components in our vehicles. Interesting, because I believe they did put out a press release where they were trying to increase the number of suppliers to be able to reduce some of those negative impacts on single sourcing. So, still listed here, as well as for the manufacture of our vehicles. Yes, Dominique RJ, it is gambling. Um, Apologies. They could expect delays to the extent our current or future partners do not continue doing business with us or fail to meet agreed upon timelines. And again, we're going to see how much of the current accounts payable, what kind of number that is. And it's difficult to keep OEMs and suppliers um, engaged with you when you're not paying them. Um, Otherwise, are unable to deliver components or manufacture vehicles as expected. There is risk of potential disputes with partners, and we could be affected by adverse publicity related to our partners, whether or not such publicity is related to their collaboration with us. If for any reasons an OEM supplier or service provider becomes unable to continue their current commitments or does not perform under current agreements, meaning non-disclosure agreements, you got to keep it quiet. We may seek alternative arrangements, and there's a risk that we would not be successful in obtaining the necessary components for our vehicles. In addition, although we intend to be involved in material decisions in the supply chain process, given that we rely on our partners to meet our quality standards, there can be no assurance that we will be able to maintain high quality standards. Well, as a producer, as an assembler, you can do quality testing there at your facility, at least on the critical to life components. Let me read a couple more of these. Excuse me. Because we are currently dependent on a number of dealers, customers, the loss of a significant dealer could adversely affect our operating results. We rely on complex machinery for operations, and production involves a significant degree of risk and uncertainty in terms of operational performance and cost. We rely on the development and functionality of complex software technology systems in coordination with vendors and suppliers in order to produce our EVs. There can be no assurance such systems will successfully be developed or be reliable. We may be negatively impacted by any early obsolescence of our manufacturing equipment. We may be negatively impacted by any early obsolescence of our vehicles. And I think we're going to see that on this filing. We are dependent on our suppliers, a significant number of which are single or limited source suppliers. Inability of these suppliers to deliver necessary components of our vehicles in a timely manner and at a price and volume acceptable to us could have material adverse effects on our business prospects and operating results. If any of our suppliers become economically distressed or go bankrupt, we may be required to provide substantial financial support or take other measures to ensure supplies of components or materials, which could incur or increase our costs, affect our liquidity, or cause production disruptions. Our business models as yet to be fully tested, and any failure to successfully commercialize our strategic plans would have an adverse effect on our operating results and business, harm our reputation, and could result in substantial liabilities that exceed our resources. We may not be able to accurately estimate the supply and demand for our vehicles, which could result in a variety of inefficiencies in our business and hinder our ability to generate revenue. If we fail to accurately predict our manufacturing requirements, we could incur additional costs or experience delays. We could experience cost increases or disruptions in the supply of raw materials or other components used in our vehicles. If we're unable to establish an arrangement for the sustainable supply of batteries for our vehicles, our business would be materially and adversely harmed. If our vehicles fail to perform as expected, our ability to develop, market, and sell or lease our electric vehicles could be harmed. Let's read this section. Our vehicles may contain defects in design and manufacture that may cause them to not perform as expected or may require repair, recalls, and design changes. Our vehicles use a substantial amount of software code to operate, and software products are inherently complex and often contain defects and errors. Well, you should probably test them then. We have a limited time frame reference by which to evaluate the long-term performance of our systems and vehicles. There can be no assurance that we will be able to detect and fix any defects in our vehicles prior to their sale to customers. Probably look at a quality control, probably do a configuration review before any of these defective vehicles, leave your facility. There's a whole list of ways that you could mitigate this risk. If any of our vehicles fail to perform as expected, we may need to delay deliveries. Well, you've done plenty of deliveries already, but just delayed sales. And or initiate product recalls and or compensate damages to our dealers or customers, possibly exceeding the revenues received upon sales, which could adversely affect our brand. I don't think that's going to be the big issue there. I don't think that's going to be the straw that breaks the camel's back. In our target markets and could adversely affect our business prospects as a result of operations. We have minimal experience servicing and repairing our vehicles. Well, that's why you hired that service company to come in and take care of it. The inability to adequately service vehicles may adversely affect our business. So again, why is Mullen Automotive worried about repairing these vehicles when they hired National Fleet to come in and take care of those vehicles? Our service may not be generally accepted by our users. If we are unable to provide quality customer service, our business and reputation may be materially and adversely affected. Thank you for stating the obvious. The automotive market is highly competitive, and we may not be successful in successful in competing in this industry. I think you've already kind of shown that. I don't know if a forward-looking statement is required, but more power to you. The automotive industry and our technology are rapidly evolving and may be subject to unforeseen changes. Developments in alternative technologies include, but not limited to, hydrogen may adversely affect the demand of our electric vehicles. So, hydrogen fuel cell. So far, it's pretty minuscule in the country. Maybe in Oregon and California, there's a little bit, but overall, I think EV still has a good foothold here. Our future growth depends on the demand for and upon the dealers and end customer fleet managers' willingness to adopt our electric vehicles. That's true. That's why you should have a good sales team that can really pitch and show that these vehicles are what the customers and fleet managers need. And those pilot lot programs should have been able to do that. And if they weren't able to do that, maybe you really need to reassess this class 1, class 3 vehicle situation. In addition, this is just my opinion. In addition, the demand for our vehicles and services will highly depend upon the adoption by consumers of new energy vehicles in general and electric vehicles in particular. The market for alternative fuels, hybrid EVs, is relatively new and is characterized by rapidly changing technologies, price competition, numerous competitors, evolving government regulation and industry standards, and uncertain customer demands and behaviors. I'm not going to read through this long bulleted list, but again, please feel free to do so. Changes in tax laws may materially adversely affect our business prospects, financial condition, and operating results. The unavailability, reduction, or elimination of government and economic incentives could have a material adverse effect on our business prospects, financial condition, and operating results. So again, talking about those tax credits that are available in the state of California and the state of Massachusetts, if those go away, it could affect their financial future. But they were available all year and they didn't seem to help the financial future too much. Again, in my opinion. If we fail to manage our future growth efficiently, we may not be able to develop, manufacture, market, and sell or lease our vehicles successfully. So, yeah. It's a true statement. So I hope that they're doing everything they can when they select their team members. Their board of directors is looking at all of these various senior managers and directors and supervisors and ensuring that they have the right people for the job to ensure that they are successful. Insufficient Warranty reserves to cover future warranty claims could materially adversely affect our business prospects, financial condition, and operating results. We may not succeed in establishing, maintaining, strengthening the Mullen brand, which would materially adversely affect customer acceptance of our vehicle and components and our business revenues and prospects. Probably didn't help at the CS event when the side view mirror fell off of that vehicle. At least that's my thoughts. Doing business internationally creates operational and financial risks for our business. Well, you did hire a pretty high up executive to help run your international business, but now you're saying that that creates operational financial risks. You also had a lot of PRs talking about overseas ventures, overseas revenue streams, but now it's creating operational and financial risks for your business. Very interesting. We are highly dependent on the services of David Mishry, our Chief Executive Officer. Remember, this is the individual that helps get those secured notes, those contracts. He helps sign all those documents to ensure that the company will have the cash from the market cap to continue running. We're highly dependent on the services of David Mishry, our founder and chief executive officer. Mr. Mishry is the source of many, if not most, of the ideas and execution driving us. So if he is the main source of most of the ideas and execution driving you, and you're having a hard time with execution over this past year, maybe the board should really take a look over the past 15 years, over the past 2 years, over the past 1 year, over the past 6 months, and really decide if a new person needs to take over. If Mr. Mishry were to discontinue his service to us due to death, disability, or any other reason, we would be significantly disadvantaged. I'm sure someone could help sign those contracts to keep those ELOC agreements coming and those senior secured notes with warranties attached, with warrants attached. I'm sure someone else could do that. But if you're looking for someone with some innovation and ways to reduce costs, to lean out your electric vehicle operations, I haven't seen this done yet. We are exposed to risks related to relationships with related parties. Prior to its spinoff, a separate entity, and the closing of the merger on November 5th, 2021, the company operated as a division of Mullen Technologies, an entity in which the company's CEO has a controlling financial interest, and of which he is also the CEO and chairman. The company and MTI, Mullen Technologies Inc., entered into a transaction service agreement pursuant to which the company incurred approximately $1.2 million and $0.9 million of disbursements on behalf of MTI during the years ended September 30th, 22 and 2023. In the grand scheme of the 2.3 billion, I don't even know why this paragraph has much value, but we'll continue on. On January 16th, 2024, the company terminated the transition service agreement between the company and MTI and received a cash payment and full settlement of all outstanding amounts, including outstanding notes receivable, advances, and related interest and penalties of approximately $2.7 million. Furthermore, some of the company's executive officers and directors also hold positions at Drive It. Whoa, right here. This is great that they're putting this right on the financial plan. I hope Yoda shows up here soon. A startup independent enterprise planning to be in the business of operating electric vehicle superstores. Kyle, I would agree. No competent person would want to step into this mess. They would need to be put on blood pressure medication immediately. And let's be honest, from what I am reading so far and from what I've seen, this is amateur hour at the best. At this time, it is planned for the company to provide its portfolio of new commercial EVs to Drive It as part of their offerings. So they've got 6 dealers already. But let's add a 7th and let's let it be with the same company that has a difficult time executing on anything. David Mishry, the company chairman, chief executive officer, president, and chairman, is also the chairman and board of directors of Drive It. Jonathan New, chief financial officer, is also chief financial officer of Drive It. And Puckett, a director and chair auditor committee of Mullen, is also director of Drive It. So all the same people that are currently running Mullen to the ground in terms of profit and cash burn, just calling it as it is, my opinion here. They're the same people that are in charge of Drive It, and it makes sense for them to now be put in the reins of Drive It and offer these commercial vehicles themselves. I'm having a hard time connecting the dots. Ignacio Novoa and Mark Better service as directors for both companies. Michaela Brown, wow, she got put in here. The executive assistant she's now a director of operations for Mullen and serves as a director of Drive It. So again, it's basically all the same people running the show at Mullen are running it at Drive It. But we're not going to do a full merger and acquisition. We're gonna utilize them. We're gonna pay them 2 paychecks to do no work that actually helps the shareholders recoup any of their contributions. Related party transactions that present difficult conflicts of interest could result in disadvantages to Mullen and may impair investor confidence. I would agree. These same people would probably impact investor confidence, just off of historicals, which could materially and adversely affect us. Related party transactions could also cause us to become materially dependent on related parties in the ongoing conduct of our business, and related parties may be motivated by personal interests to pursue courses of action that are not necessarily in the best interest of our company and our stockholders. Yeah, they're going to be motivated to take money from the company. It's probably not in best interest of shareholders. In all related party transactions, there is a risk that even if the company personnel negotiated on behalf of the company, so are they talking to each other? Is this a split personality situation? I mean, which side of the table do they sit on, folks? Um, the company personnel negotiate on behalf of the company with a related party are striving to ensure that the terms and transactions are arm's length. The related party's influence may be such that the transaction terms could be viewed as favorable to that related party. This is just so confusing. No wonder it took so much time for them to get this out. They're literally going to negotiate terms with themselves. It's kind of funny. Plus, the related party transactions could be perceived as potential conflict of interest, since the transaction may benefit the related party. Yeah, this forward-looking statement is explaining exactly how they plan on transferring cash. Such conflicts could cause an individual in our management to seek to advance his or her economic interest. Oh man, if it's such a conflict of interest, why even engage and drive it? Why not just stick with one of the other 6 dealers that are there and maybe just hold off on this or find another automotive company that's willing to do business with Drive It. Anyway, the related party's influence may be such that the transaction terms could be viewed as favorable to that related party. Plus, the related party transactions could be perceived as potential conflict of interest. I'm sorry, we're here, folks. Such conflicts could cause the individual in our management to seek to advance his or her economic interests or the economic interests of certain related parties above ours. Further, the appearance of conflicts of interest created by related party transactions could impair the confidence of our investors. I don't know which investors still have confidence, but I guess that's still possible. Our business may be adversely affected by labor and union activities. Our business could be adversely impacted by global or regional catastrophic events. Our business could be adversely impacted by the cancellation of our contracts involving the sale of commercial vehicles. Failure of cybersecurity. Yeah, I could see Randy Marinotto canceling that contract, not selling any of those vehicles. At least it's not hitting Mullen's balance sheet. Failure of cybersecurity and privacy concerns could subject us to lawsuits and penalties, damaging our reputation and brand and harm our business and results of operations. I'm going to skip this section here. We may need to defend ourselves against patent or trademark infringement claims, and we may not be able to prevent others from unauthorized use of our intellectual property, which may be time consuming and would cause us to incur substantial costs and harm our business and competitive position. So, very interesting. Our future patent applications may not issue as patents. which may have a material adverse effect on our ability to prevent others from commercially exploiting our products similar to ours. Yeah, if you're having a hard time producing and assembling these vehicles and you're spending the majority of your money on research and design of products that just don't seem to come out, probably will have a hard time generating successful patent applications. We may be subject to damages resulting from claims that we or our employees have wrongfully used or disclosed alleged trade secrets of our employees' former employers. So again, folks, we know that some of these uh, current and previous employees have came from other OEMs in the automotive industry. So are they stating here that they potentially were exploiting the knowledge that these individuals had to the point to where they potentially could be sued uh, because of trade secrets? That's just my interpretation. Could be wrong. Our vehicles are subject to motor vehicle standards and substantial regulation, and failure to satisfy such mandated safety standards or regulations or unfavorable changes to such regulations would have a material adverse effect on our business and operating results. That is true. If you want to read through all of this section, you can. But according to them, their vehicles are acceptable to this National Highway Traffic and Safety Administration. We may become subject to produce liability claims, which would and could harm our financial condition and liquidity if we are unable to successfully defend or insure against such claims. Well, it's really just a matter of the truth. If you can't defend the claim, then maybe the claim's correct. It's tough to defend against the truth. We face risks and uncertainties related to litigation, regulatory actions, and government investigations and inquiries. I'm hoping that the government investigation includes the SEC. Again, that's just my personal hope and wishes. We are or will be subject to anti corruption, anti bribery, anti money laundering, financial and economic sanctions, and similar laws, and noncompliance with such laws can subject us to administrative, civil, criminal fines, penalties, collateral consequences, remedial measures, and legal expenses, all of which could adversely affect our business results of operations, financial condition, and reputation. So this is pretty funny. We are or will be subject to anti-corruption, anti-bribery, anti-money laundering. I find that rather interesting that it's not they may, it's that they are or they will be subject to. So interested to see what type of news, what type of potential repercussions come from this section. They even talk about the UK Bribery Act. So again, we know that Mullen has expanded some of their LLC or some of their brand over to the UK. Interesting that they're talking about the UK with bribery. I wonder if there's any issues that came up and someone tried to be paid off and now they're subject to some bribery issues. I'm just speculating here. That's all we can really do until it comes out. Noncompliance with anti-corruption, anti-bribery, anti-money laundering, or financial economic sanction laws could subject us to whistleblower complaints. Yeah, I would say so. Some people just don't care about that NDA, and if they're a scorned former employee, they potentially would go for a whistleblower. Adverse media coverage, investigations, and severe administrative, civil, and criminal sanctions, collateral consequences, remedial measures, and legal expenses, all of which could materially and adversely affect our business results, financial condition, reputation. In addition, changes in economic sanction laws in the future could adversely impact our business and investments in our shares. Not shareholders, they're investments in our shares. Isn't that interesting? Is that a typo or was this a Freudian slip? You'll have to ask yourself that. Failure to improve our operational and financial systems to support our expected growth, increasingly complex business arrangements and rules governing revenue and expense recognition, and inability to do so will adversely affect our billing and reporting. Failure to build or finance infrastructure and improve our accounting systems and controls could impair our ability to comply with the financial reporting and internal controls required for publicly traded companies. So again, if you're going to put it on your forward-looking statement that you believe that this is a deficiency, why not spend a little bit of that $2.3 billion to remedy that? We are subject to various environmental laws and regulations that could impose substantial costs upon us and cause delays in operating our manufacturing facilities. Yeah, those dead and degraded batteries, that's potentially hazard waste, and that would be pretty expensive and environmentally unfriendly if you have to dispose of that. So yeah, I could see that costing a decent amount of money and causing delay as new batteries would need to get purchased. Changes in U.S. and international trade policies, including the export-import controls and laws, particularly in regards to China, may adversely impact our business and operating results. So, talking about Trump, talking about the tariffs, again, it's a good thing they were stockpiling these 2022 vehicles. But unfortunately, as we will see, they wrote off quite a bit of those. We're going to skip this section here. If you'd like to read along in these paragraphs, please feel free. I'm going to continue on. We were almost done with all of these forward-looking statements. I find it interesting that looking over this filing, we're about a third of the way done on the filing, and so far it's all been forward-looking. It's all of the potential warnings for investors and ways to make sure that they stay above reproach with the SEC and NASDAQ. Our ability to utilize our net operating loss and tax credit carry forwards to offset future taxable income may be subject to certain limitations. Yeah, if they can continue writing off that $2.3 billion of loss, they probably won't have to pay taxes for the foreseeable decade. We're not going to read about cybersecurity. Again, if that's your forte, please take a look at that. Continuing on to properties, they talk about the headquarters of Bria. Talk about Irvine, California, which has their engineering, design, and development team. Talk about the rent that they pay at the facilities. I'm not going to go through all these facilities. If you want to know how much they're paying on rent, the sizes of their locations, it's all here. I'd be interested to see if they're behind on rent, but I'm going to just continue on past this section here, folks. Skipping these sections here, going into the market information. Again, they're still traded under MULN. Hasn't shifted over to the OTC as of yet. And they had a total of 818 registered shareholders. Very interesting. These would be the ones that actually log their stocks with the Continental Stock Transfer and Trust Company. Again, they're not going to give any dividends. They've said that multiple times. Talks a little bit about some of those equity compensation plans. They'll go into more details later on. And getting down into the details. If you are still awake after this long, drawn out, forward looking expose, I'm happy because we are now getting into the cost, the revenue, the operational results. And again, they're still claiming to be early stage company, even though they're 15 years old. So they're still not quite sure how to properly report their financial results. But this is what they've shared with us. Revenue from sales. Going from 2023 to 2024, this is about 200% increase in revenue. But taking a look at that next line item, cost of revenue has went up by 6,000%. And when I first looked at this, I thought to myself, how in the world would it cost that much to assemble these Class 3 vehicles and to add a backup camera on these Class 1 vans and potentially swap out a battery on the bottom side of their sled? But we'll talk a little bit about that number as it is broken down for us in a future page. And looking at that gross profit slash loss, definitely a loss there. 15.7 million. This is not their G&A. This is just for their vehicle sales. So again, that's a 17,252% change in profit. So as we all thought they would be profitable, it is very apparent that that is not the case, at least from this initial page here. Continuing on, looking at that G&A, that did go down. It went from 215 million to 181 million, so a 16% decrease on G&A. Their research and development, in my opinion, stayed pretty static, pretty stagnant. Only a 3% reduction there on R&D. And recall, they sunset their consumer vehicle segment to really just focus in on the commercial Class 1 and Class 3 vehicles. They mentioned back in fiscal year 23 that that Class 1 vehicle had completed the homologation. We have yet to hear about any two-seater homologation, crash tests, or any kind of results. Um, it seems like a rather large amount of money. And I do believe that Mr. C-Payne also questioned them on why such a large amount of R&D. Moving on to the next section, here's your impairment of intangible assets. So again, talking about Bollinger Motors, talking about Elms, talking about Romeo Power. They still feel that in this fiscal year, that those assets have depreciated by more than their market cap. They've depreciated by 73 million. That would be a 1,151% increase in impairment. It's not a good move. Impairment is not great. Next is impairment of goodwill. That comes in at 30 million. So a 53% decrease in their impairment of goodwill. Looking down at an impairment of rights of use assets. This one's a rather new one for me, as there's no percent to compare against, but an additional $11.5 million is spent on the right of use assets. We'll see if we can find a little bit more details on that as we continue on. But overall, let's look at just the operating expenses, the loss of operations. It went from $377.77 million in 2023 fiscal year to $391.826 million in fiscal year 24. That is a 4% increase in loss of operations. So again, with all their cost-cutting measurements that they put in place, it seems that all that has fallen quite flat when looking at loss from operations. Other income expenses. Initial recognition of derivative liabilities. This is a substantial decrease compared to fiscal year 23. As they mentioned, they're having a hard time sourcing additional shares, getting them registered, really looking at the difference in market cap. Kind of makes sense why the derivative liabilities would be so much smaller, as company value has decreased by 89%, or just based off of this number, in my opinion. Other financial costs was this ELOC commitment fee. This is what I really wanted to key in on. So if you do recall, so far to date, company has generated $1.1 million of cash for this ELOC agreement, but they have had to pay financing costs of $6 million. So really, even this ELOC agreement that they've signed and that they've started to utilize, they're still underwater by close to $5 million. Next is going to be the initial recognition of warrants. So $13.6 million of recognition of warrants. So these would be potentially the investors that said, we don't want any more shares. I'm not going to go off of a cashless basis. I need the money now. So, and if I'm incorrect on that statement, by all means, please put that in the chat, in the comments. I'd love to get some feedback on how this is going so far. Gain loss on warrants and derivative liability revaluation. Again, that went from a negative 116 million to a positive 4.5 million, showing 104% change or shift. So does appear that for this year, looks like they had a slight increase on their warrants and derivative liability revaluation. Their gain loss on disposal of fixed assets, they've lost $511,000 on fixed asset depreciation. Oh, I'm sorry, disposal, throwing out about $500,000 worth of fixed assets. Interest expense, 2.4 million in interest. That has remained rather flat. And then total other income slash expense, you could see a rather large change in expense. And just looking down the net loss, going from 1 billion in net loss for 23 down to a $500,000 in net loss in 24. The main key contributor and factor in the difference is really just recognition of derivative liabilities. So they lost less market cap this year compared to last year. Looking a little bit further down, net loss attributable to non-controlling interests. Again, that is more negative. And total net loss attributed to stockholders. It has a 53% decrease in net loss of attributed to stockholders. So instead of stockholders losing $1 billion, almost $1 billion, they're down to just 457 million in losses to us common shareholders. Looking down a little bit further, let's look at that net loss per share. Again, this has a significant change in valuation, going from $157,000 loss per share. And remember, this is due to all the reverse splits. So if you were holding a share of Mullen Automotive back in 2023, that share would have a ratio of 157,000 compared to net loss of 2024 at $1,425. Weighted average shares outstanding, basic and diluted. Very interesting. Look at how many additional shares were required in fiscal year 24 compared to 23. And again, just my thoughts on that is because the market cap is so small and because there are so many warrants being issued and it just continues spiraling down, it takes a lot of additional shares to be generated in order to maintain that same price that was sold in that security purchase agreement. Looking into revenues, let's take a quick look at this, shall we? Starting out with fiscal year 24, total units invoiced 443. So they invoiced 180 Mullen Class 3s, 258 Mullen Class 1. That would be the urban delivery vehicle. This is not campus. This is that fully homologated, according to Mullen Automotive, Class 1 van, and 5 Bollinger B4 trucks. So, of all the PRs for Mullen Automotive and Bollinger, they got 5 of these trucks put on this financial statement. And remember, this is back in September 30th. It's been quite a while due to the late filing and the long extended period of time for one of these smaller filers. Looking at amount invoiced, total amount invoiced coming in at 20 million. Again, this is dollars and thousands, so $20,929,000 in invoiced. 11.6 million is Class 3 trucks, 8.5 million in Class 1 vans, and $703,000 in their Bollinger B4s. Well, let's look at revenue recognized. Again, $20 million for the year. Not enough for a single quarter on their cost of operations. But from a revenue standpoint, for the entire year, they are able to recognize $1,094,000 in revenue. I would love to know how many vehicles we have for revenue recognition. I guess you could do the math based on the sticker price to see how many total Class 3 trucks, Class 1 vans, and Bollinger B4s were actually officially sold to customers. Looking down at September 30th, 2023, you can see total revenue recognized was 366,000. So that is a large multiple on revenue recognized. However, the cost of operations has quite a bit of an increase. And let's go over that right now. Looking at the cost of revenue. The cost of revenue for the year ending September 30th, 2024 totaled 16.9 million. So that is that massive additional cost. So where did that come from? How was it calculated? So the cost of goods sold amounted to 1.3 million. So just the vehicle sales alone was 1.3 million. So let's quickly take a look. So if we don't look at any of these impairments or any of these other write-offs, we just look at how much labor they put into these three different style vehicles, that cost is still higher than the vehicles sold. So I think that is very interesting. So even without this write-off amount, this inventory adjustment that we'll get into in a second, Mullen Automotive still would not have been profitable this year. That's unfortunate looking at what was conceived as a high profit amount in previous filings. So again, 0.2 million is cost of goods sold for Mullen commercial segment, which kind of makes sense. $200,000 is how much labor they put in for the total year for their commercial segment of Class 1 vans and Class 3 trucks. And Bollinger Motor put in $1.1 million of labor and other cost of goods sold. So cost of goods sold is going to be any of the actual material, any of the raw material, any of the sub-components that make up the vehicle, and then the labor it takes to produce or assemble such vehicles. So the cost encompass, and here it is here, vehicle components, parts, labor costs, tooling costs, and production-related expenses, as well as estimated warranty provisions. So again, that is a decent amount. And then Bollinger kind of explains how that $1.1 million is broken out a little bit more. So 600,000 of that is standard costs and 500,000 of that is cost variance. So cost variance would be your standard versus actual or planned versus unplanned. So they basically almost doubled their planned cost for these vehicles as originally planned. And if you just look at the Bollinger segment, then that's $703,000 of recognized revenue for those 5 Bollinger B4 trucks, or maybe less, is being overshadowed by the $1.1 million it took in components and labor and other costs. So the B4 is not profitable. So even if 100, 200, 300 of these vehicles were being produced and assembled, the biggest issue is the fact that they can't control their cost variance. They're not equipped, they're not capable currently of leaning that down. Inventory adjustments to net realizable value. So a non-cash write-down of $15.6 million was recognized for the Mullen commercial segment, primarily due to excess raw materials and slower moving inventory. The decision of net realized value involves a significant judgment, and actual results may materially differ from estimates. Further details are in the critical accounting policy estimates below. So again, let's take a second to really unpack that. So for the commercial segment of Mullen, their raw material and their slow moving inventory, all that inventory that they had stacked up in their lot, in Randy Marion's lot, that wasn't moving, they're not pushing to sell it anymore. They're writing it off. $15.6 million of raw material and inventory. All of the inventory that we saw getting shipped over from overseas that some investors got very excited for. They thought that this could be it. This could be the revenue generating opportunities here with potential high profit margins. Well, guess what? All that's now been written off. It's been scrapped out at a loss, $15.6 million of a loss. That's going to take quite a bit of Mullen commercial vehicle sales to make up that 15.6 million of loss. Moving on. R&D. I want to spend a little bit of time reading through this and getting your thoughts, or maybe if someone would like to share in the chat. But R&D, that was a pretty large dollar amount. I think it was around 180 million or so. I don't want to scroll back up in R&D costs. So research and development expenses decreased by 2.5 million. Oh, here it is. I'm sorry. It's right here. 77.4 million. I must have been combining some of these costs. So it did decrease by 3%. So it went from 77.4 million in 23 to 74.9 million in 24. How much information are they going to give us on what's included in this 74.9, almost $75 million? To date, our research and development expenses have consisted primarily of engineering and consulting services in connection with the development and design of our EVs. That's a very vague statement. I think as a shareholder, it would be nice. I feel that shareholders should be owed a little bit more explanation on that $75 million of spend. Anyways, looking at the G&A section, these are all the non-production expenses. So not the cost of goods sold, all the team members that could have been feverishly assembling these vehicles, that 200,000 at Mullen's commercial, the 1.1 million at Bollinger, taking that out of the picture, looking at the rest of the expenses. This would be what we're paying these executives, these board members, these directors, these marketing experts, these lack of experience accountants. That's what this bucket's for. They include all non-production expenses incurred by us in any given period. This includes expenses such as professional fees. So, hey, could be some consultants. We've seen some social media influencers have to put in a disclaimer that they were getting paid by Mullen for posts. So again, salaries, rent, repairs, maintenance, utilities, office expenses, employee benefits, depreciation and amortization, advertising and marketing. Again, advertising and marketing, it's a big chunk, folks. We're going to take a look and see how big that is in a little bit. All goes into this G&A bucket. Also, settlements and penalties, taxes, licenses, and other expenses. They expense advertising costs as incurred. General and administrative expenses decreased. They reduced 33.9 million or 16%. So their G&A went from 215.8 million to 181.9 million. So that's where I got that 180 million from. It's that G&A expense line. So again, I feel that is a rather expensive line item for such a small amount of revenue. R&D equals grift. I like that. That is true. I can appreciate that. That is they're grifting off of the shareholders. That's probably the best explanation for this expense line item. All right. Primarily due to the decrease. Oh, so they are explaining how they were able to reduce their G&A by this miraculous 16%. Due to decrease in settlements and penalties, they paid less in lawsuits. That's what they're saying, and in stock-based compensation to CEO. Wow, he's taken one for the team, folks. His performance stock award agreements, he took less of these, and it kind of makes sense because there's been less performance going on to be able to take some of these awards for. Although certain expenses increased, like advertising and promotion, professional fees, depreciation, etc. So again, 16% decrease for some of the liability costs, and the CEO not meeting some of the expected targets on performance awards. But that advertising and promotion, it's going up. Those social media crusaders, those people writing the press releases, putting out all of those tweets on behalf of Mullen Automotive, um, going to these random events that they showcase and provide some videos and pictures of. All those expenses increased, but they still wrote off over $15 million of raw material inventory. So I think they need to do a little bit better job of marketing. to try to draw in the customers. Again, just my thoughts. Looking down into interest expense, it increased by approximately $44.4 million. So, yeah, they're incurring more debt. So, their interest is going up from 5 million through the 12 months ending in 23 to 49.4 million, almost $50 million of interest expense for the 12 months September of 2024. This was primarily due to the amortization of the original issue discount of these convertible notes. So again, these specific investors are purchasing shares of Mullen Automotive, um, and they hold these notes and incur a significant amount of interest plus warrants. And Mullen has been unable to pay them. We'll see that in a table as we continue. Uh, Convertible notes issued and partially converted by the company in the second half of fiscal year ending September 3rd, 30th, 2024. Yes, it is shocking that Nikola filed bankruptcy before Mullen Automotive, Rodney. I do agree with that. But Nikola is looking to put their shareholders out of the misery. No more reverse splits, no more equity financing for those shareholders. They will have the opportunity to take their losses. Looking at impairment, due to unfavorable market conditions and decline of the market price of the company's common stock, we've tested long-lived assets for recoverability. As a result of the impairment test performed during the year ending of September 30th, 24, the company recognized impairment losses around $119.2 million. That related to goodwill, property, plant, equipment, intangible assets, right-of-use assets. It's an increase of 34 million compared to last year. We'll talk a little bit more about that in a section below. There's some additional financing costs. We talked a little bit about that $6 million of expenses to start up this ELOC agreement, as well as some of the other derivative liability and reevaluation. So I'm not going to focus here about this section, but let's continue on. Waived/accrued accumulated preferred dividends and other capital transactions with preferred stockholders. So another $13.9 million of loss in 2023. Again, there's some additional fractional shares. And whenever you reverse split your shares at an excess amount, it's already been 4 times, there will be 5 times. Some of these shareholders, they've got less than 100 when you're doing a 1 for a 100. Some of them have less than 25 if doing that 1 for 25. So the point is, some of these shareholders had less than a single share, but the company has a roundup policy where that shareholder is able to hold on and grasp that single share still, giving them that full cost average all down to just one single share. But the company does incur a loss when that happens. So let's continue reading about that a little bit. It says, represented primarily by fair value of common stock issued to avoid fractional shares on reverse stock splits. $5.2 million were spent in fiscal year 24 on avoiding fractional shares. That is incredible. 5 times the revenue generated on their sales. And 8.6 million of financial result from exchange of Series C preferred and Series E preferred. Let's not get into all that. Let's continue reading down. The net loss attributable to common stockholders. So, how much overall did these shareholders lose? 471 million, or 1,425 per share for the 12 months ending in 24, compared to 964.9 million, or 157,405 dollars per share for the 12-month period of 2023. So that is a very, very large amount of loss for the shareholders in both 23 and 24. We're going to skip the operating segments. We don't need to rehash that. We're going to skip the reverse stock split rules. We'll skip the liquidity and capital resources for now. You know what? This talks about their cash on hand. Let's read this section. To date, we have yet to generate any significant revenue from our business operations. We have funded our capital expenditure and working capital requirements through the sale of equity securities. Thank you, common shareholders. As discussed below, our ability to successfully expand our business will depend on many factors, including our working capital needs, the availability of equity or debt financing, and over time, and our ability to generate cash flows from operations. So again, if the shareholders quit buying their shares, they're going to dry up. Their revenue source will dry up. The company's principal source of liquidity consists of existing cash and restricted cash of approximately 10.7 million as of September 30th, 24. And they talk about throughout that 12-month period, the company used approximately 185.6 million of cash for operating activities. So again, that is a rather small amount of operating activities cash burn compared to their overall loss. The net working capital on September 20th, or sorry, September 30th, 2024, getting tired here, folks, was negative and amounted to approximately 120 million, or approximately 38.5 million after excluding derivative liabilities and liabilities to issue stock. For the year ending September 30th, 24, the company has incurred a net loss of 505.8 million. So 185 million for operating activities, but 505.8 million of net loss. So again, why are they spending so much on G&A? Why are they spending so much on R&D and so little on their operating activities? So the company believes that its available liquidity will not be sufficient to meet its current obligations for a period of at least 12 months, about 12 days, from the date of filing of this annual report on Form 10-K. Accordingly, the company has concluded there is a substantial doubt about its ability to continue as a going concern. Without additional funding, the company may be unable to continue operations and could be required to seek bankruptcy protection within 30 days of the issuance of these financial statements. So again, they're saying within a month they could close up shop. And recall from earlier when we discussed those senior secured note holders are getting the liquidated assets, whatever has any value. So those common shareholders will not most likely have anything left. Management is pursuing several strategies to address liquidity concerns, raising additional capital through equity or debt financing. What a great strategy. It's worked so well for you in the past. Can't wait to read your PRs. Executing cost reduction measures and operational restructuring. Exploring strategic alternatives, including partnership or asset sales. Interesting. Again, cost reduction didn't happen in 24 to the severity that they stated. And partnerships and asset sales. Who are you trying to give all of your assets in joining a venture with? Is it going to be Drive It? Is it going to be Yoda? It'll be interesting to see, no doubt. And again, that's only if the shareholders stop funding the equity and debt financing. Despite these efforts, there are no assurance that these initiatives will be successful. If the company cannot secure additional funding in the immediate term, it may be required to curtail operations significantly. They already did that. They only spent 200,000 on cost of goods sold last year, or seek bankruptcy protection. These consolidated financial statements do not include any adjustments to the carrying amounts of assets or liabilities that may result from the outcome of these uncertainties. Now let's go over their debt, shall we? Total debt current is 5.399, almost $5.4 million. Where does this debt come from? 2.385 million comes from their matured notes that are already due. They're on default. And another 332,000 of a 10% interest rate. Again, it's due. It's in default. And the last section, $20.3 million from these senior convertible notes. Again, you wonder why these investors took them to court and got some additional shares after their S3 write up. It's because the interest rate, which started at 15%, it's now jumped to 20%. They can't pay for these notes. and it's due. It's under cross default. But just to try to lessen the sting here, there's a section here for a debt discount to convertible notes. And you know what that debt discount is? That is the shareholders' equity. They offered more shares to reduce the cost of some of these senior secured notes. So again, that is a lot of interest accruing, a lot of debt to be had. So let's read this section here. I want to look at bullet number 2. Since this is $20 million worth of debt, let's see exactly what this sub bullet says. As of September 30th, 2024, or footnote, the company's senior convertible notes totaling 20.3 million and accumulative interest approximately 0.3 million were cross default due to non-payment of the 200,000 or the 0.2 million that matured in September 24. So Mullen Automotive couldn't even pay $200,000 in September of 24, even though they have 10 million cash plus reserves or plus restricted, or sorry, 10 million of cash plus restricted. As a result, the entire principal balance became due immediately. So these investors wanted it all, allowing investors to demand full repayment. Additionally, an interest rate increased from 15 to 20%. However, investors have not requested immediate cash payment. Why would they want cash payment when they can get shares? Those shares are going to be of much more value with those warrants attached. Um, in December 2024, the court has approved a settlement agreement between the company and holders of the senior convertible notes, and by the date these financial statements are available to be issued, almost full amount of the senior convertible notes and accumulated interest has been converted to shares of common stock. So Mullen can't pay the debt using the shareholder equity that they've generated throughout the year. So what do? Just create more shareholder equity, convert that debt into shares. Very interesting. Great approach. Still works today. Looking a little bit further down into some of their other debts, another 2.7 million of carried over debt. The majority is this principal of 2.7 of their matured loans. And also this Newbridge real estate note, $5 million of October 2023. Not sure about Newbridge real estate. That's a new one to me. Not sure if this is part of the Bollinger or not. And Josh Castle, I agree. These numbers are terrible. So there you are. Some of the other indebtedness. $7.7 million indebted as of October 1st, 23. The total carrying amount, 7.4 million. And then getting into fiscal year 24, where did they end up at? They reduced their debt slightly. Yay, shareholder equity. Notes issued in principal. They raised $68 million. I'm sorry, that is actually they're indebted $68.3 million. The original interest discount and debt issuance cost at inception is at $65 million, $65.1 million. Looking down into the amortization of the original discount, after you go ahead and flush that out, it's at $47.7 million. Paid in cash. How much are they paying in cash versus shares? Negative $4.9 million. So they were able to reduce their debt by paying $5 million in cash and then having that $65 million of the original interest discount and the debt issuance. So again, with all of this funny numbers, money changing pockets, they have a total carried over debt at 5.3, almost 5.4 million. And they talk a little bit about their mature notes, some of their real estate. $5 million real estate note at 9% interest. This is contractual maturity at 24. It's due. It was due. Huh. And they still owe 5 million. So not looking too great. I don't know if there's any lien on that real estate yet or not, but don't think they're going to be able to pay that bill. We're going to skip all of the numbers for 23. We're going to go down to cash flows. Let's look at that used, not positive cash flow, negative cash flow. Operating activities. So their cash flow of operating activities went from 179 million in fiscal year 23 to 185.5 million in fiscal year 24. What I think is interesting with that is the fact that they were starting up assembly. There's a lot of operating activities going on in fiscal year 23, but yet operating activities increased to 185 million in fiscal year 24. That's a shocking amount, in my opinion. Interest activities. They did pay less interest in their cash. They paid 107.9 million in interest in 23 compared to 16.1 million in 24. And then financing activities. This is where they raised money. You can see in 23 they were successful at raising, thanks to us shareholders, $358 million in financing activities through the sale of various security purchase agreements, compared to fiscal year 24 of just 56.7 million. And then you have to recall this is due to the market cap continuing to shrink and be rinsed out. The only thing sustaining the market cap is new retail buying more shares. Cash flows used in investing activities. We're going to go ahead and look at this section here. We expect these costs to decrease in the near future as we have ramped up production activity during 2024. I didn't really hear too much after that 500 vehicle production, but I guess Bollinger Motors did ramp up in 2024. Net cash used in investing activities was 16.1 million in the year ending 24. That's an 85 decrease from 107 million used in fiscal year 23. So there's a lot less money being used in investment. Cash flows for that financing activity. We're basically just reading through some of the bulleted section above, my understanding. They finance their operations primarily through the issuance of convertible notes and warrants. Net cash provided by financing activities was 56.8 million in September of 24 compared to 358 million in fiscal year 23. Looking a little bit onto their operational lease commitments, those different facilities, whether it be Irvin, Fullerton, or potentially Bria, what is that looking like from a lease standpoint? Well, fiscal year 25, they're going to owe 6.4 million. They only have 10 million in cash and reserves. So that's going to be a pretty tough lease bill to pay when you're looking at a potential of $1 million of revenue with a significant cost greater than that. So negative profit on the vehicle sales and a high lease payment. Kind of makes sense that they would want to probably cancel these different leases and consolidate efforts. I'm not going to read through the off-balance sheet agreement. Not going to look at some of the critical accounting policies and estimates. Uh, Again, if you are an accountant and you'd like to break that down for us all, that'd be great. We're going to continue down a little bit further. Management's annual report on internal control over financial reporting. We're going to continue past this section. As they mentioned in their forward-looking statements, their internal control over their financial reporting. They do not have very good assurance on this reporting. So, kind of remediation efforts to address the material weakness and other changes. I was griping about that. I'm so glad they have a section here. What do they plan on doing? The aforementioned material weakness were first identified in 22. So great. They've had multiple years to be able to correct this material weakness. While the company had significantly improved its internal control over financial reporting, even though they still state that they're lacking experience and internal control on financial reporting, the material weakness remains unremediated as of September 30th, 2024. As the company has moved from development stage to production and sale of vehicles, the company's remediation efforts will continue throughout 2025. So, not going to get any better. Not going to fire and hire someone to change that. Interesting choice, leaders. During the year end of September 30th, 2024, the management completed the following actions in accordance with the remediation plan. Formalization of policies and procedures. Accounting and IT policies were updated. Awesome. Thanks for updating those policies. Enhance review controls. Review controls for inventory and revenue accounting. Closed processes were redesigned with compensating controls implemented to ensure accurate reporting and timely disclosures. They've rolled out new revenue policy to marketing and sales organizations and continue to closely monitor revenue and transactions documented. I wonder if that means that when people were submitting their expense reports, they were having a hard time tracking some of that cash spent. Strengthened technical expertise. Additional leadership roles with expertise in GAAP financial reporting and public company controls have been hired and external consultants engaged to address gaps in accounting for complex transactions. But it's interesting they still say that they lack that experience, although they've hired people with expertise in GAAP financial reporting. In addition to the remedial actions taken to date, the company is considering the full extent of the procedures to implement in order to remediate the material weaknesses described above. So they do provide a plan down here, and that's great because it's important to maintain compliance with NASDAQ to be able to get those S3 filings back up and running. They've got to put together that plan of how they're going to fix the fact that they're slow to put out these filings when it comes to their finances. So again, please feel free to read through some of this section. Looks like they're trying to change one of their ERP systems, which is basically their database for tracking their transactions. Inventory tracking adjustments, not realizable value, and improve controls over financial transactions. Rodney, 100%, this company is going bankrupt soon. Please put money on it, but don't put money in it. Just my opinion, not giving financial advice. Evaluating skill set gaps and hiring additional accounting financial reporting. So it's great. After 2+ years, they're finally looking at hiring the right people for the job. I'm going to go ahead and skip the rest of this section. Going down to the next section in bold here, we've got limitations on effectiveness of controls procedures. So again, admission of their lack of effectiveness on their procedures. Excuse me. All right. I'm going to skip 19B. And we go into the directors, executive officers, and corporate governance. You can see a list of their highly paid but not highly skilled directors, executive officers, and corporate governance. And I only say that they're not highly skilled based off of the information they shared in their forward-looking statements, how they lack experience, how they're still considered a startup. Let's continue past there. I don't think we need to read about these people. I don't care about their bios. I don't think that the Mary Winter, Ken Puckett, and Mark Better and John Anderson qualify as independent directors. But that's my thought. Wow, insider trading policy. We have adopted trading policies and procedures governing the purchase, sale, and or dispositions of the registrant securities by directors, officers, employees, or the registrant itself that are reasonably designed to remote compliance with insider trading laws, rules, and regulations of any listing standards applicable to the company. What I find interesting with that statement is the fact that they were so late on filing some of these insider transactions. So I think they need to revisit that policy. Don't really need to go into the code of ethics. You can look through some of the lawsuits filed against some of the executives when it comes to that. There's an audit committee let's skip that. And a compensation committee. It's great. I think they should probably look at a brand new committee because they're burning through way too much money on their G&A. But that's just my opinion. Nominating and corporate governance committee. So another committee. Don't really care about that. Looking at salary and compensation. This is a fun one. David Mishry, fiscal year 24, $750,000 for salary. Stock awards at 2.5 million. Total compensation for the year, close to 3 times the revenue at $3.2 million. But that is a substantial reduction considering the previous year he awarded himself a handsome amount of stock awards for $300,000 of revenue generated. He earned a total of 49.6 million in fiscal year 23. Jonathan New had a nice little award option come in, gave himself $2 million in fiscal year 24. Not to overshadow the executive still. And Chester Bragato, Chief Accounting Officer. Again, not sure how this guy earned his $1.9 million, considering how much of material weakness are part of these filings. But we will continue. Share-based compensation. Definitely worth taking a look at this section, understanding the year-end one share and 1,135 shares for the years ending in 2024 and 2023. And of course, that's because it's split adjusted. Anyone who earned a share, even the insiders, have barely a handful of shares remaining after all of those splits. There's a section about a clawback policy. There's a section on page 81 about the CEO performance awards. None of this is new to any of the shareholders. So I will not read through it all. And I do not see any numbers in terms of any remaining performance awards here. So we'll just continue down. It looks like they break out the performance awards into the 2022 and the 2023 sections. I'm sure there'll be a table as we continue a little bit further down. Many shareholders have looked at these performance awards and looked at how much money David Mishry has awarded himself for. And it's definitely worth a chuckle, in my opinion. And let's look at that table together. Joining the Russell Index in 2022, got himself 3.9 million. Going into fiscal year 23, where he raked in $40.4 million of shareholder equity. He hit his feature milestone, non-USA distribution. So remember, they shipped a vehicle over to Ireland, still sitting in the dealer's showroom. However, he did receive $6.6 million. From what I recall, I don't even think that vehicle is worth $50,000. Next section would be this capital benchmark. He has awarded himself money for taking money from shareholders. USA Distribution, distributing those vehicles to sit at Randy Marion's lot for $10 million. And going down further, a pilot lot vehicle delivery, $5.6 million for doing a pilot lot with no significant sales from it. And then here's some additional capital benchmarks. Another almost $1 million for, again, raising money via shareholder equity and dilution. Looking at 24, there was 2 sections put in this section for the PSA of 2022 and PSA of 2023. And these would be the shares ending the fiscal year 24. And then they did share a little bit. They gave us a sneak peek of additional shares that he did receive additional money he did receive for some of these last couple. So, vehicle delivery of the Mullen 5. Very interesting that he awarded himself almost $1 million for a vehicle that cost probably $3 or $4 million for that German manufacturer to fully assemble and ship over, just for it to fall apart during the CES showcase. Accelerated development milestone. Another $1.3 million for accelerating the operations, which has done nothing but burn cash. Capital benchmark. Again, another shareholder equity. At least in this circumstance, he only awarded himself $2,700. And battery development for that class 1. Again, I guess he's taking an L in terms of that. And going back to the drawing board, only give himself $1,693. And doing some of that advanced battery development. Remember, he walked us shareholders via a video through the Fullerton location, showing us those various pieces of assets that were acquired via the auction sale and put those fancy green LED lights on. He ordered himself $238,000, almost $239,000 for that battery development walkthrough. So total shares to be issued altogether for his performance, 46,944,000. That is a substantial amount of money over the course of just 2.5 years. And there's an interesting section. Here's an employment and severance agreement. Very interesting. So if they are to fire David Mishry, here's a pretty large amount of money. Not that he needs any more money, but they would continue to pay even more. I think as shareholders, you rip the Band-Aid off. You fire the guy. You take the little bit of cost on the chin. It'll probably come in the form of additional promissory notes and shareholder equity, but maybe get yourself a new CEO. Just my opinion. Those are my thoughts. A CFO left in 2022. Chief Accounting Officer left in 2023. I'm sorry, was hired in 2023, starting November 27th, 2023, with an annual salary of $400,000. And if he's terminated, he's going to get at least 6 months of that salary, $200,000, plus whatever kind of cycle. I'm not going to read through the rest of these. Talks about a couple more of these people, how they're going to get a little bit of additional parachute. Very interesting, though, that Mary Winter has received $60,000 in consulting payments. And her job title is a corporate secretary and director. Secretary of Services. Very interesting. $60,000 annually. Very interesting. Okay, moving on. Some non-employee director compensation. We won't go through all this. Again, feel free to pause. Feel free to read through this SEC filing at your convenience. Looking at that common stock, 61,595,743. This is the same number, and this is as of January 21st, 2025. They show the beneficial owners. So all those shares being awarded, this is what these executives have left. And then, of course, our favorite investment groups. We have Isusa Holdings. We have JADR. And we have Equitas Capital. Holding down the fort at just under 10% of common stock. Here's the remaining equity compensation plan for that was approved by stockholders at $20 million. This includes part of the CEO performance awards. Moving on down, We talk again about this transition service agreement with MTI. Many of us have already read most of that. But let's look at this last little section. So during the fiscal year ending September 30th, company paid $55,000 for certain expenses of other companies under control of the company's CEO, and $25,000 was reimbursed by 2024. So very interesting. Really. Drive It. This is great. I'm so glad that Drive It is now going to be part of these filings moving forward. Oh, almost $1 million in fees for a company that has yet to do anything. And we get down to the exhibits. All right. I think, ah, how convenient. Past all the exhibits, we get into the asset section. Again, if you were clicking through all the hyperlinks, you probably would have jumped straight to some of these sections. Let's take a quick look at assets. So, Mullen Automotive, going from fiscal year 23, they had $198 million in assets, the majority of which was in cash and cash equivalents, as well as some prepaid expenses, about $25 million in prepaids. So, fast forwarding to fiscal year 24 end, their assets are down to just 63 million. Looking at the differential, only 10 million in cash. Restricted cash still sitting around about the same amount, close to half a million at 426,000. And then let's take a look at the next item. This is inventory. So they've increased their inventory by about 21,000. I'm sorry, 21 million. But they also wrote off over $15 million of inventory. Again, very interesting. Very, very interesting on how they keep accruing additional inventory and then write it off with very little sales. Looking at total assets. So that was just the top section when we're looking at, cash, inventory, and prepaids. Now we're going to take a look at the rest of the property. So again, I'm seeing another substantial drop in value, and that's because of some of these intangibles. So total assets in fiscal year 23 ended at 421.7 million, whereas total assets in fiscal year 24 is at 178.6 million. Majority of the assets are still sitting at that property and plant. Intangible assets, they've written off the majority of those due to impairments, to my knowledge. And a couple things that they no longer have is any value on goodwill and any value on party receivables. So they have no additional receivables coming in. They did have an increase on some non-concurrent assets. Looking down on liabilities, let's look at this accounts payable. I think that is very interesting. So accounts payable, again, when it comes to paying their vendors and other contractors, in fiscal year 23, they still owed those vendors and contractors a little over 13 million. Looking at fiscal year 24, they owe 41 million. They have no cash, only 10 million. $10 million to run a business with an incredible amount of cash burn. And this is as of September 30th, 2024. Remember that, folks. We're now in January, almost February. So we're talking 5 months later. How are they still afloat? What's going on? I'm very interested to know how they are not bankrupt at this very moment with only 10 million cash. Again, maybe they got some of the prepaids. Maybe they kind of reneged on that. I don't know. I'm interested to understand how they are still open. And yes, they do still have that 37 million in inventory. We're going to take a look at that inventory, Mr. Castle, in just a little bit. So going back to liabilities, sorry about that. They've increased their liabilities, which makes sense. They are starting to accrue more debt, more liabilities. Derivative liabilities is going up. Leasing liabilities is going up. The only reduction I'm seeing is there a liability to issue shares? Because they've issued most of those shares. And another one that has reduced is going to be notes payable. So they have less notes remaining. All right. And that restricted cash is in the form of refundable deposits. Looking at the total liability line, it's going from 148.8 million up to 195.1 million. So again, for the first time, Mullen Automotive has more liabilities than they have assets. Please take note of that. When it comes to bankruptcy and liquidation, most of this is getting wiped. Looking at total liabilities in stockholder equity, it was 421.7 million. It is now only 178.6 million. How is it such a large difference? Well, it has to do with this additional paid in capital, 2.29 billion. This is cumulative. Very, very large amount. Stockholders' equity slash deficit attributable to the company stockholders. So they did have equity of 208 million at least. And if I'm not mistaken, that has a little bit to do with their assets versus liabilities. And now they're at a negative 28 million. Not looking great. Going into the revenue, again, this is that same one broken down again, just comparing the differences. 366,000 compared to 1,094,000. Look at the cost of revenue. We know that a large chunk of this was writing off of some raw material and inventory items, showing a total profit of negative 15.799 thousand. Operating expenses, I don't want to read through all these same ones again. Just know that operating expenses has increased. Know that the net loss has decreased. Again, that's because there was less market cap, less shareholder equity to cut through. And you can see that right here on this initial recognition of derivative liabilities. It's been mostly paid for. So total net loss is about half compared to fiscal year 23. So if anyone was a bull on Mullen Automotive, they would probably just focus in on just a couple of these little things, put their blinders on, squint their eyes, and talk about maybe one or two of these items that could look good without any context applied. Net loss per share, we talked about that. That has significantly dropped. Here's some additional consolidated statements. This has to do with the preferred stock and common stock. I will not go through all of these numbers. Thank you all for sticking along with me as we go through this adventure of this 10K that we have been anxiously waiting since the end of December. Again, just looking through all of the cash flows, it's a somewhat of a regurgitation of what we saw in terms of some of the operating expenses. Here it is at 185, and some of their investment and also financing. So operating expense, investing expense, and financing activities. Changing cash. So in 2023, they actually gained 71 million in cash based off of some of that shareholder equity. And that was at the beginning period versus the ending period. So looking at that, the total gain in changing cash for fiscal year 23 was 155.6 million. A decent amount of cash on hand for them to do various PRs with. Whereas fiscal year 24, they're down to just 10.7 million, as mentioned before. All right. And there is another large section down here below. I don't want to go through all of this. I want to save you all from any repeat information. But I will quickly scan, as this is my first time seeing some of these sections here, to make sure there's nothing worth highlighting and discussing as we get down to the end of this section here. And as promised, I will be delivering on the Kendall Payne next post, as well as anything we can find from Michelle, one of our retail accountants that has done a lot of work pouring through some of these filings to help us make sense of some of this jargon. And if anyone has a specific page they want me to go to, by all means, drop that into the chat. I'll jump down to that and we can review together. But if not, we're getting close to the end of this section. Here's that inventory, Mr. Castle. Let's look at this breakdown here. Raw materials, they're sitting at 12.6 million. So this would not be completed goods. This is probably batteries, could be tires, could be those second seats that they purchased and had imported over here, but we heard nothing about. Their work in process, 4.3 million. So partially completed goods, still working on that. Finished goods. This is what's available there at their facility, 3.8 million. And then goods delivered to their dealers for distribution, $16.6 million worth. So there's that breakdown, Mr. Castle, on inventory, that 37 million sitting there. As you can see, raw materials didn't really move much. Work in process didn't move much. Finished goods, they did complete some additional vehicles and kept them there at their facility there. So all in all, that's the inventory breakdown. We will continue through the rest of this section here below. Talk a little bit more about some of the mature notes. Again, we don't want to repeat through something unless it's going to go into some granular details. That would definitely help us. I have yet to see any information on the liabilities. So we've got to find a section where they discuss some of the lawsuits. We're getting into some of the financing here. So that's very interesting. Since the loss is no longer probable, the accrual was reversed. So this is the one of the promissory notes. Oh, that is right. That I do recall this. This was back around Christmas time of 23 when they did talk about starting that 15 million and they were going to have it at a discount. That's right, an $18 million discount. Everyone was scratching their heads. That never actually came to fruition. They terminated that thing. Wow. So with no money being provided, the investors still argued over that 18 million. Incredible. Going over, hello, Mr. Fun Daddy. Thank you for joining us. Some of us will be jumping over to your space call momentarily if that is still going on. Apologize for the long, lengthy YouTube live here, but just really wanted to make sure we scrub through every last little bit of the 10K filings and thoroughly vetted out the information we have. So $50 million in senior secured notes. Again, let's see where the last of this provides us for a period beginning May 14th. Conditions applied. So they did receive an additional 52.6 of this one. So some of this is kind of repeated we already heard about. Still trying to find some of the liabilities. I'd love to look at some of these legal cases. We will get down into those details, those messy, messy details as we continue. They go through their warrant calculations. In case any of the investors are wondering, how in the world did they go through $2.3 billion? Take a look at some of these warrant calculations. Those warrants were definitely not beneficial for any of the investors. Looking down a little bit further, going into some more of these preferred D warrants, Chianti warrants. A lot of copy and paste off of previous annual filings. Not going to go over the derivative liabilities again, or the stockholder deficit. Of course, there has been no dividends declared or paid. This junior A1 preferred stock, just going to be another Another press release mentioned that ended up expiring useless. Series E preferred stock. Looking a little bit further down into here. Redemption rights, dividends, liquidation. Ah, it talks about how they're going to divvy out any of their remaining assets in the event of bankruptcy. Here's basically the weighting of all these preferred stock owners. Voting rights, loss per share. There's that almost $1 billion loss per share in 23 and about a half billion in 24. Share-based compensation. Again, we already reviewed this section here. I never did quite understand why many of these companies repeat the same information in their filings twice. I see this all the time. Getting down into consultants, I think we definitely need to read this section. Let's see if we can find any of these Twitter consultants or YouTube consultants listed here. From time to time, the company also issues share-based compensation to external consultants providing consulting, marketing, R&D, legal, and other services. Weighted average term of such contract is 6 months. So if anyone's wondering how long some of these paid consultants are in the money, it's 6 months. So if you ever see a scorned consultant maybe starting to get a little frustrated with David Misery on how things are going with their investment, maybe their 6-month contract is up. And it's their way, as the squeaky oil typically gets the oil. I'm sorry, as the squeaky wheel typically gets the oil. Uh, but let's continue reading through here. The number of shares specified within the original individual agreements or a monetary value of those shares, if applicable, is usually negotiated by our CEO and approved by the board. Very interesting. The CEO himself touches base with each of these consultants. Doesn't seem like very effective management of time, but hey, to each their own. These costs are generally presented as professional fees within general administrative, and certain qualifying costs may be presented as part of research and development expenses. So 400,000 in the year ending 24 and 5 million in the year ending 23. That was what they were paying these consultants for the R&D efforts. A part of these share-based awards is classified as equity and accounted for similar to stock-based compensation to employees. Another part of the company's share-based awards to consultants is classified as liabilities, mainly if the number of shares a consultant is entitled to is predominantly based on monetary value fixed in the contract. Wow. So if they're guaranteed, let's say $10,000 and the share price plummets, they're getting a lot more shares for that $10,000. So very interesting that even these these consultants have contracts with non-dilutive properties. Total value of share-based liabilities settled in stock during the year ending of September 30th, 2024 and 2023 was 32.4 million and 13 million respectively. You are paying a lot of promoters. And I can say Mr. Mystery because it says right here that all these people are going through you. Very interesting there, Mr. Mystery. The company generally practices prepayment for future services of the consultants by unrestricted shares of common stock. I wonder if they provide them money to buy the stock and then they can screenshot it to show everyone how many shares they purchased and are holding long. I would be interested to see the background of that. I know I will never get that, but still interesting to know. In this case, a prepaid asset is recognized on the balance sheet as is amortized over the period the consultant is delivering their services to the company. These prepaid costs were 3.3 million as of fiscal year ending 24, 5.1 million fiscal year ending 23. And this amount represents the total unrecognized compensation costs related to non-vested share-based compensation agreements under the plan to non-employees. Weighted average period over these costs are expected to be recognized as after the balance sheet after the balance sheet date is 4 months. I'm not going to go through the rest of this section here, but decent number of shares granted to consultants. classified as equity. So 353,000 shares were granted during fiscal year 24. Very interesting. 300,000 non-vested at the end of the year. And those are just the equity ones. The liability ones are much, much more. Much, much more. So this would be money. So some of these consultants, they don't want the share price. They don't want the stock. They would rather have the money. However, look at the asterisk. The number of shares and the stock price have been retroactively restated. So my apologies. It says right here, shares. So yeah, they are getting shares. That is incredible. 3.2 million shares are being given to consultants to help either peddle the Mullen name or maybe help them with their books. I'm not quite sure what all is on here for the consultants. We did have a quick list of what's considered a consultant. I don't want to rehash that again. Some of it was R&D, some of it was that general, some of it was legal as well. So maybe they're paying some of their attorneys in shares, share-based compensation. Very interesting. Combining the non-vested at the end of the year, it's at 2.334. Very interesting. And some of these, uh, this is after doing this reverse split of one for 2.25 million. That's the current multiplier, but we have one more reverse split potentially coming, folks. That multiplier could potentially be seeing 200 million. One for 200 million. We'll have to see. And there's some additional information about some of these accrued expenses. We are almost to the bottom here, folks. I appreciate you sticking around for this. I know this was a very, very long coverage. Um, did not take the time to prepare for this because it just came out tonight, but wanted to give it my best go. And I'll definitely take some feedback and criticism. I'm sure in a space call in the near future. All right. They go over their property and plant equipment. Again, this is their assets. Really not showing much of a difference across the board here. Some depreciation, which is interesting. So let's look at that actually. Total cost of assets. So it looks like they've added about $18 million. Where's the big, oh, this big number here. Machinery and equipment. That's right. They mentioned that they had purchased some additional battery manufacturing equipment. So interesting. All right. Again, the Romeo Power assets were back in September of 2023, so they would have been part of this 27 million, if I'm not mistaken. I guess depending on when they settled some of the costs. Did they go over it here? This is just the impairment. Okay. Continuing on, non-controlling interest. Talking about Bollinger Motors, leases. Talk about their leasing. I really want to get into some of the legal information. They're probably saving it for last. Some of their income taxes. All right, federal, California, deferred tax assets. All right, contingencies and claims. Here we go, folks. This is the probably last section, but typically the most exciting section. Looking at all these people that have went toe to toe with Mullen Automotive or with some of their specific employees. So let's take a look, starting with Keonto Motor, see if there's anything different here. No loss contingencies have been accrued with respect to this matter as of fiscal year 24. Other than those paid, see above, company cannot reasonably estimate either probability or additional losses or their magnitude, if any, based on available information known to management. So it looks like this specific Keonto Motor situation is, for the most part, completed. Um, if I'm reading this wrong, someone in the chat, Please speak or forever hold your comment until this is done. International Business Machines, IBM. Company has recognized, oh, this is year ending 2022. So nothing new on IBM, just talking about another one of their failed litigations, where IBM actually had to pay, or I'm sorry, Mullen Automotive had to pay out. The GM Group, here we go. This is actually something I believe Michelle highlighted, and we'll take a look at that later. This is very telling. The company has accrued 30 million as a probable settlement expense as of September 30th, 2024, in addition to 7 million that has been paid earlier. So 37 million probable settlement expense. They are saying here that most likely they're going to be paying GM. GM is going to win this either via settlement agreement or based off of this arbitration amount here. Says they've still been slow playing them, but all of the motions back and forth were complete. They're waiting for I'm assuming, the attorney to finally weigh in. But according to Mullen, not according to GM, according to Mullen, it's now probable that they will have to pay this out. So looking at $10 million cash on hand at the end of September of 2024, here we are again. Like I mentioned, almost 5 months, 6 months in on this thing. No, I'm sorry. We 4 months in on this. So the company has been burning cash, and now they're most likely going to have to um, provide 30 million to GEM. So I will be interested to see if they go for share-based compensate or share-based payments, or if GM will play hardball and say we want cash, so start selling your assets. I will be very interested to see. Looking at the next section here. Oh, the Mullen stockholder litigation. Let's read this entire section. On May 5th, 2022, plaintiff Margaret Schwab, as purported stockholder, filed a putative class action complaint in the United States District Court for Central District of California against the company, as well as its chief executive officer, David Michery, and chief executive officer of a predecessor entity, Oleg Führer. The Schwab lawsuit was brought by Schwab both individually and on behalf of the putative class of purchasers of the company's securities, claiming false or misleading statements regarding the company's business partnerships, technology, and manufacturing capabilities, alleging violations of sections 10B, 20A of the Security Exchange Act. On September 23rd, 2022, a court-appointed lead plaintiff filed a consolidated amendment class action complaint against the company, Michery, and the company's predecessor, Mullen Technologies, premised on the same purported violations of the Exchange Act, seeking to certify a putative class of shareholders and seeking an award monetary damages as well as reasonable fees and expenses on August 14th, 2024. The parties entered a stipulation and agreement of settlement to settle the Securities Action matter subject to payment of $5.4 million by the company and $1.8 million by the company's D&O insurers. The settlement is subject to court's final approval. The company has accrued $5.4 million as probable settlement expense as of September 30th. So we should probably add up all of these probable settlement expenses that they haven't paid out yet. So far, we're sitting at 35.4. Continuing, let's just see if this says no provisions has been accrued. So we'll skip this section here. Not worth going through that. Again, no loss contingencies have been accrued in respect to this matter for fiscal year 24. Looking into the next section, no loss contingencies have been accrued. And let's take a look. Oh, this one was filed a notice of voluntary dismissal. How unfortunate. Damages of claims relating to Net Element merger and Net Element's divested of a payment processing business. But this one has been filed and voluntarily dismissed. This is just some of their related party transactions. They talked about the transition service agreement. I already mentioned the 55,000, in which only 25,000 so far has been reimbursed. Excuse me. Hmm. Let's read this section. I believe this was noted in one of the last filings. On July 18th, 2024, the company entered into an asset purchase agreement with Mullen Technologies, pursuant to which the company assumed a lease for a premises located in Oceanside, California. Ah, no, this is for that used car lot on Oceanside and all the equipment and inventory in the premises. Michelle shared this information with me as well as staffing and other infrastructure for vehicle sales repairs for consideration of $1.4 million. So the company purchased Oceanside from Mullen Technologies for 1.4 million in July of 24. We'll have to read note for business combinations if I can find that section here while we're still reading. Just seeing if there's any more worth reading here. Hmm. Rendered services. Okay. Segment information. Don't care to read about the different segments of vehicles. Consolidated financial statements. Okay, this is going to split out Bollinger and Mullen Commercial, showing each of their balance sheets versus the total. So that's an interesting take. I don't want to really go through all of these. If you want to pause or check out, I believe it's going to be F66 on the SEC filing. You can definitely read about this. This top section is for the segments here. So we already talked about revenue for Bollinger, revenue for Mullen. Very interested to look at the differences between the two. But total segment assets, 63 million versus 115 million. And that is for the previous year. All right, subsequent events. Glad we kept going. So this is very interesting. So now we are getting into the nitty and gritty after September 30th, 2024. What all has occurred? Company management has evaluated subsequent events through January 24th, 2025, which would have been yesterday, the day of this filing, which is the date these financial statements were available to be issued. Except as discussed below, management has determined that there were no material subsequent events which required recognition, adjustment to, or disclosure in the financial statements. So again, they waited a month, they were late on the filing, and they deemed that they didn't need to change anything. Significant stock issuances after, excuse me, after the balance sheet date. So what all has happened since the date? After the balance sheet date, again, September 30th, 2024, the company issued 57 million shares of common stock, mainly upon exercise of warrants, conversion of senior convertible notes, and issuance of shares to consultants under stock-based compensation plans. So again, trying everything they can to raise some additional capital. Shareholder equity was just diluted by 57 million since the filing. I'm sorry, since the end of fiscal year 24. And then some settlement agreements for some matured notes. Company reached an agreement with holders of matured notes and loan advances in the amount of 2.7 million as accumulated interest in the amount of 1.8 million. The liabilities would be settled pursuant to the Security Act by issuance of shares of common stock worth 3 million. Liability was fully settled by December of 24 by issuing shares of common stock in several installments. Another settlement for more senior secured notes. This one's the one that we read through earlier, talking about the initial $20.5 million worth of convertible notes, and they ended up settling with some additional stock, and they keep the same price floor at $1.16. And then looking down a little bit further, on October 2024, Bollinger Motors, majority-owned subsidiary of Mullen Automotive, issued an amended and restated secured promissory note for $10 million to Robert Bollinger. That's right. I do remember hearing about this when they paid Mr. Bollinger $10 million to support the production and sale of Bollinger's Class 4 truck. So basically, they just paid him to be the marketing guy for $10 million. The note bears an interest at 15 million. I'm sorry, they issued a promissory note to him. I believe that this is him as an investor now in Mullen Automotive slash Bollinger. 10 million of his own money he's putting up for the operations, specifically for the Bollinger side. He's not putting any of his money towards the commercial side of Mullen, but he's doing it at a 15% interest annually. That's right. And they only have to pay interest only starting November 29th of 2024. So have they been paying? Interesting. The principal repayment due by October 30th, 2026. So they will pay just the 15% interest on the $10 million until it matures on October 30th of 26. It is secured by part of the assets of Bollinger Motors. So he did find a way to basically, if the company does end up going bankrupt, he'll be able to get at least $10 million of assets out of that, except for the inventory and certain IP. So he won't be able to purchase any of the trucks out of his own money, but some of the other equipment, anything outside of inventory and intellectual property is up for grabs for that $10 million in the event of default. Additional investments in Bollinger. In accordance with the stock purchase agreement signed on July 26, 24, the company, as part of activities to launch production in Bollinger segment, invested after the balance sheet date an additional $6 million in newly issued shares of the subsidiary, increasing controlling interest of the company to approximately 68%. That's correct. There was some filings as well for that in terms of increasing their stake of Bollinger. What else has occurred since then? This is great. This is kind of like looking through a reunion, debriefing on all of these different SEC filings that crept up on us all. On December 12th, 24, company issued an additional aggregate principal amount of approximately 4.6 million, which was 4.4 plus that 5 discounted amount of senior secured convertible notes under the investment agreement dated May 14th, 2024. That date will go on in infamy as the date at which Mullen Automotive began to die, in my opinion. I'm saying it now. There's just way too much of defaulted payments and debt because of this, and no additional money to pay it. I believe that these specific investors will be part of the liquidation process in the near future. Again, my speculation. In conjunction with the notes, the company issued 5-year warrants exercisable for 16,862 shares of common stock on a cash basis. In conjunction, I'm jumping down here. In conjunction with this transaction, the company entered into an additional investment rights agreement granting investors the right through December 12th, 2025 to purchase up to $4.6 million in additional notes and related warrants on similar terms. Again, I would be interested to see if the company, this investment company, is willing to purchase additional notes, knowing that Mullen is defaulting on their interest payments. We'll see. On or about December 26, 2024, company issued additional aggregate principal amount of approximately 4.2 of senior secured notes under the investment rights pursuant to this securities purchase agreement on May 14th, 2024. On this one, they had issued 5-year warrants for up to an aggregate of 8,255,000. That's more than 10% of the overall float as of the filing, at least, or yeah, as of this filing, because it was provided in early January. I think it was January 21st. So there's some warrants there. Well, let's continue. On December 31st, 2024, the company, pursuant to the existing investment rights security purchase agreement, again, this May 14th date, it's coming to bite them, of approximately 5.3 million. So again, they ended up utilizing some more of these notes. So these companies, these investment companies, they're willing to purchase shares to run up the buy volume to initiate this pump, in my opinion, because they're getting these additional warrants. Like I said, it's a buy one get two free. Now they're able to rapidly sell off these warrants, convert these warrants to shares, and then sell those off and drop the price ever so rapidly. Looking down this section here, the new additional investment rights granted in December, as well as the notes and warrants issued on December 26, are subject to the approval of the NASDAQ listing rule. And they talked about that potential issuance still cannot exceed 19.99%. So again, we'll see what happens at the annual meeting. This is a separate meeting from the reverse stock split meeting that will be coming prior to this one. And there's some proxy statements. Oh, this is an interesting one. I haven't even seen a filing for this one. On January 23rd, 2025, this is very fresh. The company entered into a security purchase agreement with certain investors for the sale of an aggregate principal amount of approximately 6.3 million. Again, of some additional senior secured convertible notes with warrants exercisable on cash basis of 32,116,906 shares of common stock. That's incredible because the overall share count as of January 21st was 60 million. So we're talking about half of the float, half of the outstanding share count in warrants as part of this new SPA. Very interesting. Well, let's continue. The January notes accrue interest at 15%, including that 5% original discount, and mature in 4 months from the date of issuance. Wow. Upon any event of default, the interest rate automatically increases to 20% per year. The holder may convert the outstanding principal amount and accrued but unpaid interest on the January notes into shares of common stock at the lower of 39 cents. Look at that new floor. Of the closing sale price of the common stock on the date of the company's registration settlement statement, of the Form S1 is declared effective. So let me put this into perspective. Right before the reverse stock split occurs, they are going to try to run up the share count. That way, the share count can stay above 1 million post reverse split. That's what I'm thinking is happening right here. But we'll have to wait and see. So looking at that lowest daily volume of weighted average price for 5 trading days, the conversion price will not be less than 8 cents per share, not subject to reverse stock split. That's interesting because if they go under 10 cents per share, they have only so many days to regain that, or they will automatically be delisted. So very interesting tactic, putting a conversion price less than 10 cents on here, down to 8. January warrants will have a cash exercise price equal to 43 cents and may also be exercised on a cashless basis as a security for payment of the amounts due and payable under the January notes. The company collaterally assigned and granted to the holders a continuing security interest in all of the company's right, title, and interest into under the property of the company, whether then or hereafter owned, existing, acquired, or arising in wherever then or hereafter located. The January notes are senior in right of payment to all other current and future notes to which company is party. The January notes also impose restrictions on the company limiting additional debt, assets, liens, stock repurchases, outstanding debt repayment, dividends, distributions, and affiliate transactions except for specified exceptions. January notes and January warrants are not convertible by a holder to the extent that the holder or any of its affiliates would beneficially own in excess of 9.9%. Wow. So if there is a filing with information of who this investor is, I am very interested because it looks like they're literally putting their entire business as collateral for this money. So, and that is it, folks. We made it to the end of this 10K. Before we go, I want to make sure that Kendall didn't have any additional information that's worth noting. So let's switch over to X and take a look. All right, Mullen 10K finally dropped. Thank you, Mr. Castle. Nearly a month late. Time for the popcorn. First up, revenue did increase 3 times, but it cost Mullen 62 times the cost for that revenue. So he went over the COGS snafu with that 15.8 million in written losses. Or I'm sorry, that's the profit margin. It's a 15.8 million loss. Um, Jumping down a little bit further, but notably, this revenue is less than a quarter of what Mullen claimed it expected to report in their PR from October. Very likely, this is what caused the significant delay in the filing. So, if you all recall, in one of Mullen's press releases, they claimed for the quarter ending that they would have 4.5 million in revenue. They came up quite a bit short, considering they only had a million. So only about 25% of what they were claiming. And he also talked a little bit about the cash burn, which we went over. Talked a little bit, says here, Mullen total current assets now down to just 63 million, but more critically, the total current liability of 183 million exceeds the company's total assets. So we talked about this. This is the first time that I've seen that where um, the liabilities outweigh the assets. Accounts payable plus accrued expenses and current liabilities is 9 times the available total cash on hand. These are insolvency numbers. So bankruptcy right around the corner, in my opinion. You do know what a startup is, right? Uh, that's funny. And Kendall mentioned something similar, how the company has been around for going on almost 15 years. Happy 15th anniversary, Mullen Technologies and Mullen Automotive. All right, I will check Mr. Payne to see, this is just a thread, to see if he had any other information to share. Mullen itself declared that Volt, oh, that is one thing that they scrubbed completely from this 10K, and that is the Volt mobility deal. There is no mention at all about that in the filing. That is very interesting. Too bad. Mullen itself declared that Volt mobility deal is likely off since Volt has still not paid the deposit or placed any orders. So this is page 15. Let me switch back. Did I miss this, folks? I may have missed this section here, but let's just read it here from Kendall. In August 2024, we signed a 3-year purchase agreement with Volt Mobility, which subsequently assigned the contract to one of its wholly owned companies, Lesser Car Rental LLC. The agreement was for the purchase of Mullen commercial EVs at a preferred wholesale pricing for distribution in the United Arab Emirates region. As an exclusive representative, Volti Group, an independent entity which was previously described as a subsidiary of company in error, agreed to provide chargers. Volt Mobility committed to purchase 3,000 Class 3, and remember, this is a lesser car rental company, lesser, sorry, uh, 3,000 Class 3 commercial EVs with an initial deposit of 3 million for initial orders of 300 units within 60 days. Execution in the balance of the 2,700 units in calendar year 25. As of the date of this report, Mullen has fulfilled its initial commitment by providing vehicles to support homologation. However, Volt Mobility has not made the deposit nor placed the initial orders. At this time, it is not known if the company will continue the relationship and is currently investigating alternative distributors for the region. So, what do you know? It was a smoke show, as was called out by Kendall and many other Mullen retail or Mullen due diligent officers, I will call them. And Jay Castle, it was in there. Volt didn't make a PO or paid anything. Thank you for double checking that. And yes, they talked a little bit about that PR for the Pape trucks. Let me pull that up. Mullen announces Pope Trucks 3.2 million vehicle purchase with immediate delivery and revenue recognition of 50 Class 1 and Class 3 vehicles. Again, September 26, 2024 should have fallen in their 10K. You're absolutely right, sir. And you don't see it on here, do you? No, you don't. All right. I think this is just about enough. I do want to check on Michelle. I want to check on Michelle to see if she was able to find anything on the accounting side of things, as we've already read this section for Mr. Kendall. So let me switch over to Michelle. She is on a flood space right now. Hopefully she does not mind. If she does, I'm sure Mr. Flood Daddy will uh, let me know. Kyle Hamill, thanks again. Waiting for another reverse split. Short the hell out of it again. Respect. Well, that is one strategy, sir. And I will tell you, best of luck to you. And I do mean that in all sincerity. So Michelle did mention that this GEM lawsuit is probable, meaning that they will be paying that. Mentioned about the 75 million of the Volt Mobility, which is not happening. So again, a lot of very interesting items here, folks. So thank you all for watching. Appreciate your time. For those of you that stuck around for this entire 10K breakdown of Mullen Automotive for their fiscal year ending 2024. We saw quite a bit of inadequacies. They had some self-proclaimed lack of experience in their accounting procedures, material weaknesses. They talked about the fact that they have ongoing concerns of continuing. They spoke about potential bankruptcy opportunity. And then they spoke about some of those additional concerns of liquidation and how these senior secured note holders would get first dibs on whatever assets were available. And then we saw just one day prior to this 10K filing coming out, they quickly jumped on another SPA and basically tied their entire business to that SPA in the form of, if there's a default, these specific secured note holders are moved to the top of the list. So I think that's very interesting. I am looking forward to trying to dig into that filing in the near future. And I'm sure between Kendall, Michelle, and others, we will get down to the bottom of this. So with all that said, I hope you really enjoyed this 10K breakdown of Mullen Automotive. This could be their very last quarterly filing, according to some of their forward-looking statements, but we'll have to see. I would think we're going to get at least one more filing, considering December ending quarter is done and they are still in business as of January. So we'll have at least one more 10Q to go over together, folks. Again, if you like this, please consider liking this video. Subscribe to this channel if you haven't already. I do cover more than just Mullen Automotive. And again, drop some comments. Let me know your thoughts about Mullen Automotive and this 10K filing. Please point out any shred of bullishness at all in this filing. Love to discuss it with you. And with all that said, hope you all have a great rest of the day, and I'll see you on the next one.